Good morning, friends. Good morning, friends. Okay, so today we are starting. Just give me a minute. Okay, today we are starting with our revision. Just okay. So what we are going to do is I'll first set the context as to what is going to happen over the next 2 days of revision. We are starting with FM revision and then we are moving to costing revision. In FM as well as costing, I've shared you some priority list of questions. We're not going to discuss any concepts. We're just going to do questions, questions, and questions. As we practice problems, automatically your concept revision will happen. And these 120 questions for FM and 160 questions for costing, that's what I have chosen. 120 and 160 question would kind of cover 8 90 percentage of the major concepts will get revised in this. What students face difficulty in this subject is they may be aware of the concept, but when an exam situation comes and when they have to write the answer, somewhere that confidence is not coming, they are not able to solve question. So the focus in the revision will not be on concept side, the focus will be only on the practice side. As I do a question, I may briefly discuss a concept, but my major focus would be on this. Now, FM revision, we are going to do approximately 15 hours of effective classes, 7.5 hours of today and 7.5 hours of tomorrow. Effectively, only that much time will be there. In 15 hours, obviously, looking at past track record, I will take around 10 to 12 minutes for a question. So, we may cover around 80 questions and balance 40 questions is something you will try to handle at your end. This is what will happen in FM. Similar approach will happen in costing. Now, I'll quickly discuss your paper pattern. Now, as far as the paper pattern is concerned, it's a 50 mark for your FM side, 15 marks would be in MCQ side, 35 marks would be on your descriptive. In MCQ, there will be a case study of 10 marks. Sometimes they may end up even asking two case study of 6 plus 4 or 4 plus 6, and balance 15 marks, balance 5 marks will be there. Different questions, approximately 8 questions will come, which 5 to 6 would be a case scenario based question. What is case scenario? There will be a bigger problem, and from there they'll end up asking set of questions, and then there can be another element which is direct question, which could be for another 5 marks. All this, no choice is available, mandatory for us to attend. 15 marks is on the MCQ side, easily scoring area, predominantly practical based question, no theoretical based testing will be there in this 15 mark. Then comes the descriptive. In descriptive, there's a mandatory question for 15 marks, which will mostly be 5 plus 5 plus 5. So 30 marks of your paper is having no choice itself. So in case you do a selective preparation, you may get stuck here, because any area of which you are left in choice can come in the first to 15 marks or in the next to 15 marks, where choice is not available. Choice is available after that. Question 2, 3 and 4, where there will be a 10 mark question which can be broken down as 5 plus 5, 4 plus 6, 6 plus 4, 7 plus 3, 8 plus 2, the way ICI wants to break it up. In that, the first two would mostly be a practical question. Some element of theory can come there also, and the fourth question is fully a theory based question. If a student is very confident about practical problem solving, then there is no need to do theory as far as exam is concerned, because if you are confident on the practical part, theory is something which you can leave it in choice itself, because it's not mandatory for you to attend the theory from an exam point of view if you are confident on the practical side. In case you're not confident on the practical side, then obviously theory will come into picture. So theory preparation may also be needed, because it's critical that you prepare theory from an exam point of view in case paper becomes extremely challenging. Theory helps you in that paper. Otherwise, theory, you may not end up answering anything from an exam point of view. Now, looking at the past track record, this is how the distribution of marks have been. Broadly, your 9 chapters broken down past history, which I have developed into 4 blocks. Block 1, block 2, block 3 and block 4. Block 1 is the 27 marks of your paper, where you have a cost of capital chapter, capital structure, leverages and dividends. This is what I would be starting with. I'll try to cover the entire block. Block 2 is your theory block, which we are not going to cover it in the revision, where special attention could be given to chapter 1 and 2. These two chapters are predominantly important from theory point of view. Then comes your block 3, which is your ratio analysis and working capital, and finally the block 4, which is your investment decision. Now all these blocks, whenever we are doing, if you have to do concepts will come from something called as a concept book, which is there. All of this you will find in my telegram group. If you go through the concept book, you will understand that there will be something called as concept MCQ. If a student does the concept MCQ itself for most of the chapters, you'll get broad clarity on the concepts, and accordingly it's easier for you to handle any type of question. Also for FM, I have something called as concept charts, which in 40 pages will cover the entire subject. 30 to 40 pages I think will cover the entire subject. This also is there in my telegram group. Try to use this whenever you want to do your revision of concepts. Now coming back to the 4 blocks which which I have decided, I'm going to start with block 1, but before I start with block 1, a block 2, a small discussion. In block 2, if you see in the material itself, there is a summary theory notes which starts with page 68 and goes on till 79. So this summary theory notes is part of the material itself. In this 120 questions which you see, you will see the summary notes. So even if you read this and go to the exam as far as the theory component is concerned, you would be in a position to handle the theory part. So page 68 to 79, 10 pages of theory. If you prepare really well, you will be in a position to manage that. In that chapter 1 and chapter 2 itself will be some 5 pages of theory. Predominantly these 2 chapters, and then the other chapters come. So if you focus on this element of 68 to 79, your block 2 is taken care of. Take some time, spend maybe 3 to 4 hours and prepare on that. You need more explanation on the theory. Theory videos are there in YouTube, but I don't think you will have time for all that. You may have to go through quickly these, understand to the extent possible, and then reproduce it in exam in case theory gets tested. Try to remember points, understand logic, but obviously in the end you'll have to remember the points and then reproduce it. Now coming back to block 1, which is starting with cost of capital, will directly start with this chapter. Broad context. What is cost of capital? Is the term capital means long-term money. So in this chapter, we are going to learn what is the cost of raising money and what are we paying to our money providers. Money comes in different forms. It comes in the form of debt. It comes in the form of equity. It comes in the form of preference. It comes in the form of retained earnings. What are we paying to everybody? The chapter will start with certain MCQs which we are not going to cover. These MCQs are again exam MCQs, not the concept MCQs. This I am not going to cover it in the class. You can later on see. I will directly start with solving questions. Let's come to question 1. Page 6, question 1. 1 minute for you to go through the question. Okay. A company issues 10 lakh 12% debentures of 100 each. Debentures are redeemable after the expiry period of 7 years. Company is in 35% tax bracket. Calculate the cost of debt if debentures are issued at par, 10% discount, 10% premium. Brokerage is paid at 2%. What will be the cost of debenture if issues at par? Four situations are there. I may handle two situations out of this. Balance two you can do later if you want. Even if you don't do it also, it's fine. So here, first, whenever you do a cost of debt, you'll have to understand whether it's a redeemable debt or an irredeemable debt. Participate. Redeemable, irredeemable here. It is a redeemable debt. Life is given 7 years information. Question says company issues 10 lakh debentures. Doesn't really matter whether it's one debenture or 10 lakh debenture. Let's start computation of cost of debt. Computation of cost of debt. Cost of redeemable debt. Cost of redeemable debt is equal to, you can do on your own or do it along with me, that's your wish. Cost of redeemable debt is equal to interest after tax plus average other costs divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. Average funds employed. Average other cost, expand the formula, redeemable value minus net proceeds by balance life. Redeemable value minus net proceeds by balance life. I'll explain some of this as we do. Redeemable value plus net proceeds by 2. Redeemable value minus net proceeds by balance life. Redeemable value plus net proceeds by 2. Now, in case of a redeemable debt, what happens is I have to pay interest every year. Along with that, I collect something and I repay something, which sometimes I may collect only 100 rupees from the debenture holder and I repay 110, 120, 130. There's an extra cost for the company. In a rare scenario, this extra cost can be negative as well. This extra cost can be negative. What is redeemable values? What you pay on the last day. What is net proceeds? Is what you collect today. What you pay on the last day minus what you collect today divided by the balance life. Why we are dividing by life is to calculate annual cost, every year cost. Otherwise, if you don't divide by balance life, it becomes an overall cost. So here you have to divide by balance life to get the per year cost. Now, situation 1. Situation 1. Issue at 10% discount. Issue at par we are not doing. Issue at 10% discount. Issue at 10% discount. Issue at 10% discount. Cost of redeemable debt is equal to, what is the face value of the debenture? 100 into, interest is 100 into 12%. 100 into 12% into 1 minus 0.35. 100 into 12% into 1 minus 0.35. Live online guys, if any place you have a doubt, you type it in the chat box. 100 into 12% into 1 minus 0.35. Collect the material, take the material. 100 into 12% into 1 minus 0.35. Redeemable value. Question has not given any information on when it is, at what price it is redeemed. If problem is silent, redemption is at par. Problem silent, redemption is at par. So redeemable value 100. Net proceeds means what I collect today. What I collect today, I've issued the debenture at a 10% discount. Issued the debenture at a 10% discount. So we are going to collect 90 rupees today. 100 minus 90. 100 minus 90. Life is 7 years. And denominator is 100 plus 90 by 2. 100 plus 90 by 2. Final answer will convert into percentage by doing into 100. 100 into 12%, 7.8 plus 1.43 divided by 95. 9.72%. Cost of redeemable debt 9.72%. Any doubts on this? Situation 2, issue at 10% premium. Totally 4 situations are there. I'm doing only 2 situations. Issue at 10% premium. Issue at 10% premium. Everything same. Net proceeds will be different. Net proceeds is what you collect. Redeemable value is what you pay back. Redeemable value is what you pay back. Net proceeds is what you collect. What we collect here is how much? 110. And this is a unique situation where average other cost can become negative. Your average other cost can become negative also. Minus 1.43 divided by 105. Divided by 105. Your average other cost, very rare situation, can become negative also. How much? 6.07%. Any doubts on this? This is a starting question where we have calculated cost of redeemable debt. If it's irredeemable, average other cost will not come in the formula. Any doubts on this? Let's come to question 2. RBI proposes to sell a 5-year bond of 5,000 at 8% per annum. Bond amount will be amortized equally over its life. What is the bond's present value for an investor if he expects a minimum rate of return of 6%? Now, this is technically called as valuation of bond. We have done one question on cost of debt. As we proceed, you will see again cost of debt question, but this is valuation of bond. Value of any asset you want to value, present value of future cash flow. For example, if I want to value this building, present value of future rental income and the sale value of the property discounted is time value of money concept. So here I have a bond which is going to pay 8% interest, and as an investor I want a return of 6%. Bond is going to pay 8% interest, and as an investor I want 6% interest. So what we need to do is, bond will pay interest every year, cash flow, PVF, DCF. PVF is at 6%. Investor required rate of return is 6%. So PVF at 6% we have to do, and based on that we have to calculate the, just give me, PVF at 6%, you will have to do the discounting and get the value of the bond. Now write valuation of bond, question 2. Valuation of bond. Valuation of bond. Year cash flow, PVF, DCF. Year cash flow, PVF at 6%, DCF. Any asset you want to value a land, building, plant and machinery, anything needs to be valued. This is the principle. So in the bond, I'll be getting interest income every year, and I'll get back principal at some point of time. Here it's a 5-year bond, 5,000. Bond will be amortized equally. Amortized equally means every year I'll be getting back 1,000 rupees. 5,000 is the value of the bond, amortized equally. Now what is the implication of this? First year you will earn interest on entire 5,000. Second year your interest income will be down because your principal is repaid. Third year it will be further down because principal is repaid. Fourth year it will be further down. So now write year 1, 1,000 plus 5,000 into 8%. 1,000 plus 5,000 into 8%. Year 2, again you will get back 1,000, but now interest is on only 4,000 because principal already 1,000 paid. First year you have paid principal of 1,000 rupees. So now you will earn interest income. Try to, no need to of copying and all, try to understand calculation and you do it, because I write something in bracket. All this is just for your understanding. No need to write 1000 plus. Everything will be there in the printed material. Try to understand concepts rather than just noting down things. 1000 plus 4000 into 8%, and you have to do it along with me. Don't leave it. You have to do along with me. 1320. Third year 1000 plus 3000 into 8%. Fourth year 1000 plus 2000 into 8%. And last year 1000 plus 1000 into 8%. Every year you are getting back 1000 rupees along with interest income. First year on 5000, that was the opening balance. Second year on 4000 because opening balance went down. Third year on 3000. Fourth year on 2000. Fifth year on 1000, and sixth year no income because the bond is fully repaid. PVF at 6% in the calculator. 1 divided by 1.06, 0.943, 3 decimal we normally take unless question says something else. 1 divided by 1.06 equal to again 0.890, 0.840, 0.792, 0.747. Now we'll have to multiply and then put a total. That will give you the total of the bond or present value of the bond. Multiply and put a total. That will give you the present value of the bond. 1400 into 0.943. You keep doing it and you will get a total of the DCF. You will get a total of the DCF. 30 seconds for you to complete this calculation. Okay, 5262 is the value of the bond. This was a redeemable bond. In one exam situation, there was an irredeemable bond. Irredeemable bond means you'll have to use the formula of perpetuity, which I'll explain as we proceed. Now let's come to question 3. Go through this. A very good problem. Go through this. Take the book from here. Okay. TT Limited issued 20,000 10% convertible debenture of rupees 100 with a maturity period of 5 years. So convertible debenture slight bit of variation in the calculation. Formula will be same as cost of redeemable debt with certain changes. At maturity, debenture holder will have the option to convert the debenture into equity share, current market price, historical growth rate, do approximation method and IRR method. Now, approximation method is called formula based method. If problem is silent, we only do approximation method. And then they have also asked for IRR based method. Now, let's write the same formula. Cost of debt is equal to interest after tax plus average other cost divided by average funds employed. Cost of debt is equal to cost of convertible debt is equal to interest after tax plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. This is the formula we used it for the first question. What is the face value of the debenture? 100. We are paying interest of 10%. So 100 into 10% into 1 minus tax rate. 100 into 10% into 1 minus tax rate. 100 into 10% into 1 minus tax rate. I'll come to redeemable value in some time. That is where a major discussion is needed. Net proceeds is what you collect today. Have they given any issue price, anything mentioned in the question? Participate, guys. No. Take 100 as it is. Issued at par. Issued at par. Life is 5 years. Denominator. Redeemable values where some discussion is needed. Net proceeds is 100. Redeemable value, some discussion is needed. Redeemable value, come down, leave some space and come down. Redeemable value split into two. Redeem as debt, convert into equity. Redeem as debt, convert into equity. Redeem as debt, convert into equity. Now, in case of a convertible debenture, I have two choices. I can either redeem it as debt itself or convert it into equity. If I redeem it as debt, have they given any redemption value? At what value it will be redeemed? No, at par then. So if you redeem as debt, you will get 100 rupees. You will get 100 rupees. If you convert into equity, you will get 5 shares. It says at maturity, debenture holder will have the option to convert debentures into equity shares in ratio of 1:5. So right here in the side, 5 shares into each share on that maturity period. Maturity period is 5 years, will have a value. What is the value? Today the price is 20. Historical growth rate is 4%. In the calculator, 20 plus 4% for the first year, plus 4% for the second year, plus 4% for the third year, plus 4% for the fourth year, plus 4% for the fifth year. So you will have a share price of how much? 24.33. 24 point. This is expectation. Whether it happens, not happens is not my worry. 24.33. Today the price is 20. It will grow at the rate of 4% every year. So 20 plus 4% plus 4% plus 4% plus 4% plus 4% into 24.33 was the value. Now redeemable values higher of these two. I have a choice. I can redeem it as debt and get 100 rupees, or convert into shares and get 121 rupees. As a debenture holder, I will get 121 rupees. As a debenture holder, I will opt for getting 121.65. So convertible debt, an extra check is this: redeem as debt, convert into equity. I will opt for convert into equity and get 121.65. Get 121.65. Any doubts on this? Any doubts on 121.65? Now go back to the formula and write 121.65 and get the answer. That's all. This is approximation method. In the formula, use 121.65. Formula based calculation is called approximation method. .67 percentage. The important part is redeemable value for a convertible debt is not directly taking as redeem at par, premium, whatever they give. You have to take higher of the two numbers. One is redeem as debt. Problem did not mention anything. We took 100. Second is convert into equity, which we got 121.65. So obviously I'll choose 121.65. Any doubts on this? This is approximation method. Problem silent, we do only approximation method. But some questions specifically may say that go ahead and follow IRR method, or it will use the word internal rate of return method, detailed method, accurate method. If they use that word, you will have to do IRR. For doing IRR, they have given two numbers below. At 10%, we will do discounting. We may get positive NPV or negative NPV. At 15%, we will again get one positive, one negative, and accordingly we'll complete the answer. Any doubts first on the approximation method? Approximation is formula based calculation. Next, cost of debt using IRR method. Using IRR method, 6 columns: year, cash flow, PVF, DCF, PVF at 10%, DCF, PVF at 15%, and DCF. One will give positive, one will give negative. Year 0, year 0. Year 0 represents what the company is going to collect. Company is going to collect today. You can do it from company point of view, you can do it from investor point of view. Answer is going to remain same. If I do from company point of view, year 0 is right. 100 inflow plus 100. It's an inflow for the company. Company issues a debenture, they will get 100 rupees inflow, whatever was the net proceeds. 1 to 5, negative 7.5. This is the interest paid. Negative 7.5 interest paid. And year 5, negative 121.65. Negative 121.65. Negative 7.5 and negative 121.65. In the calculator, get the annuity factor, or the factors are given. Please put a total of them: 10.909, 826, 751, 683, 621, 3.790, 0.621. Factors are given in the question. You complete the calculation. Once you get the NPV, then we discuss it. PV of normally 3 decimal, DC of 2 decimals. These should be your broad numbers. If you get anything different, let me know. Anything different, any calculation errors, let me know. Negative 3.97, positive 14.39, 10% and 15%. Clear? Now I will have to use the formula of IRR. IRR is basically using a logic called interpolation. Now, right, IRR is equal to, any doubts on the calculation here? Any doubts on the calculation? Cost of debt. Instead of using the word IRR, cost of debt is equal to L1 L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. This is the formula using interpolation. More logic, everything you want. Detailed videos are there in my YouTube channel. I don't want to spend too much time on the base logic of the formula. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 represents the lower rate and L2 represents the higher rate. So L1 is 10 plus 10 plus, how much is the NPV at 10%? Negative 3.97 divided by negative 3.97 minus 14.39 into 15 minus 10. That negative and negative will get cancelled. Negative 3.97, denominator is negative, it will get cancelled and you will get 10 plus something. 3.97 divided by 18.36 into 5. It's, I think, almost 11%. 10 plus 10 plus 1. Approximate answer is 10.67. Accurate answer is 11%. Approximate is 10.67. Accurate is 11%. So, cost of 2-3 major concepts have got discussed here. Convertible debt. Convertible debt is same as normal scenario. Only change in a convertible debt is you have to first check what is the redeemable value by comparing two numbers. Redeem as debt, convert into equity. This question we did under two approaches. One is your approximation method and second is IRR method. The first question I did, if problem was saying both, I would have done both there also. Formula based is called approximate method. Problem silent, we only do formula based method. Any doubts on this? Clear? $11.08, some rounding of differences up and down can be there. This is my discussion on cost of debt from the priority questions list. I may discuss cost of debt again when I do something called as your WACC analysis. Now comes cost of equity. Let's come to question 4. Z share is selling at rupees 60, EPS is rupees 6, payout ratio is 100%. What is the cost of equity? If the payout ratio is 40%, it earns 15% on its investment opportunity. What will be the cost of equity? Now, cost of equity basically represents what are we paying to the equity guys. Equity guys get reward in the form of dividend. One major difference in a debt and equity is debt can be redeemable, irredeemable. Equity, there's no concept of redeemable, it is always irredeemable in nature, basically a perpetual, it has a perpetual life. So basic logic of cost of equity, right? Cost of equity is equal to question 4. Cost of equity is equal to D1 by P naught minus F plus growth rate. This is the basic formula which we'll use in most of the question. D1 by P naught minus F plus growth rate. Now, what is the logic is very simple. I am investing in a company. D1 divided by P naught. Ignore flotation cost. D1 divided by P naught. I invest 100 rupees today. I get back 5 rupees at the end of the year. That's called dividend. So 5 divided by 100 is 5%. That is one form of return for me. What is cost is? Basic logic you have to understand is, in this chapter, cost of company, return of investor, there are two angles. Cost of company is what company is paying every year divided by what company is getting today. That is interest or dividend is paid every year, net proceeds is collected today. Same way it is called return of investor. From company point of view it's called cost, from an investor point of view it's called return. Return of investor, what investor is getting every year divided by what investor is paying today. I have to pay today some amount to get every year some income. So in case of an equity, I will get dividend income every year plus growth. What is growth? Is capital appreciation. Share prices keep going up, keep going down in the market. So if there is a growth, that is second form of return. There are two forms of return. One form of return is called dividend. Second form of return is called capital appreciation. These together is called return of investor or cost of equity of the company. Now, in this growth calculation has some formula, all that we'll see as we proceed. So, coming to the original situation, selling at 60 rupees, 60 is P0, EPS, earnings per share is 6 rupees, payout ratio of 100%, payout ratio of 100% means dividend is also 6 rupees. Then there is some rework situation. Original situation, let's close it. D1, 6 rupees, EPS 6 rupees, 100% payout. 100% payout, dividend is also 6 rupees, price 60, 6 by 60, no growth rate. I'll explain growth rate later. 6 by 60 plus 0%. We'll originally do it in decimal and then convert into percentage. 10% is the answer. 10% is the answer. 0.10 plus 0.00. No growth originally. Rework situation will have a growth. What is that? You'll understand as we proceed. Rework. Rework says payout ratio of 40% and return of 15% of the company. Return of 15% of the company. Payout ratio of 100%, return of 15% of the company. Dividend per share is equal to earnings per share into payout ratio. Dividend per share is equal to earnings per share into payout ratio. Into payout ratio. How much is the earnings per share? 6 into 40%, 2.4. Now, one issue which can come is this 2.4, when is it going to be paid? Because we have something called as D1 and D0. What is D0? Is today's dividend. Our dividend which will be paid in immediately. D1 represents the dividend which will be paid later. Later means could be after some point of time. Today, 2025 year dividend could be called as D1 or could be called as D0 depending on when it will be paid. Some companies will pay dividend in the next 1 or 2 months. Some companies may pay dividend only by the month of October, November, which is slightly a far off situation. So D0 or D1 depends on when the dividend will be paid. Some question will say company paid, pays, all that they'll very crystal clear say. If the question is very clear in the wording saying the dividend is paid or dividend is going to be paid immediately, going to be paid in the next month, all that is D0. Next year payment will be paid in the future, all that is D1. This question have no clarity. So now right, it is assumed DPS of 2.40 is D0. D0 is current dividend. Growth rate is equal to growth rate is equal to growth rate is equal to now a company can grow. For example, I create a fixed deposit. Whenever I create an FD, every year FD will give me income. That income, if I withdraw next year, I'll get the same income only. But if I increase that income and put it in the FD itself and increase my principal value, there are two types of income you can get. Whatever income you're generating from the FD, you can tell the bank, please add it to the FD balance. So next year you will earn extra income. So you can grow whenever company retains some part of the profits and reinvest it. If I reinvest, on the reinvestment I will earn 15%. So ideally the company can grow at the rate of 15% provided they retain all the money. The company is not retaining the entire amount. So growth rate is equal to ROE into retention ratio. ROE into retention ratio. It can be called as ROE, it can be called as IRR, it can be called as rate of retained earnings, return on retained earnings. Different names will be there. Basically, whatever the company is earning 15%. If you retain 100%, we are not retaining 100. If you retain 100, it will grow at the rate of 15%. It will grow at the rate of 15% because it is earning 15% profits. So if you retain some money, full money you retain, on that I will earn 15% extra and grow at the rate of 15%. But if you are not retaining full amount, obviously I cannot grow at the rate of 15%. We are paying out 40%, hence we are retaining 60%. Hence we are retaining 60%. 15 into 60%, this is my growth rate, 9%. Next, D1, 2.4 plus 9% growth. 2.4 plus 9% growth, because we assume that to be D0. 2 point, now you apply the formula, that's all. Now you apply the formula, cost of equity is equal to D1 by P naught minus F plus growth rate. 2.616 divided by 60 minus 0, no flotation cost, plus 0.09. First write it in decimal, finally you convert into percentage. 4 decimal calculation, percentage will become 2 decimal automatically. 0.0436, 0.09, 13.36. And if you say 2.4 is D1, then the answer is 13%. So in exam situation, clarity not there, we may end up doing both because time will be there. It will not take much time to do the other calculation. The other calculation is dividend is taken as D1. If you take it as D1, it is directly 2.4 divided by 60 plus 0.09. Any doubts on this? The logic for growth is very simple. If company is earning 15%, it can grow at 15%. If company is earning 20%, it can grow at 20% provided entire amount is retained. Many organizations will not retain the entire amount, so we apply the formula ROE into retention ratio. Okay, question 5. Mr. Mehra had purchased a share of Alpha Limited for rupees 1000. He received a dividend for a period of 5 years at the rate of 10%. At the end of 5th year, he sold the share of Alpha Limited for rupees 1128. You are required to compute cost of equity as per realized yield approach. The simple formula for cost of equity was the earlier formula, D1 by P naught minus F plus growth rate. Now they have specifically used the word realized yield approach. Now this is where this logic you have to be very clear. Cost of company is equal to return of investor. So what is realized yield approach is saying is, please go ahead and calculate IRR of Mr. Mehra. Go ahead and calculate IRR of Mr. Mehra. What is IRR of Mr. Mehra? What is Mr. Mehra earning? What will he earn? Year 0, he paid something. 1 to 5 years, he got dividend income. At the end of 5th year, he sold the share. He would have earned some income. That income could be 10%, 12%, 14%. You need to calculate IRR. To calculate IRR, one positive NPV, one negative NPV. I am not going to do IRR calculation. I'll write year and cash flow. Focus will be writing year and cash flow, and then I'll show the answer, because my focus is only getting, because one calculation we have already done on IRR. Now onwards, we may not do IRR calculation. Question says realized yield approach. What is realized yield? Is cost of company is equal to return of the investor. Cost of company is equal to return of the investor. Clear? Any doubts on this? Now I have to do IRR calculation. For IRR, I need one positive, one negative NPV. We will open year cash flow. How many more columns? I don't know, because I need one positive, one negative. Last question gave 10 and 15. Here I may start with some random rate. Then I may have to do another rate to get one positive, one negative. You will open, in the class we will do only 4 columns, but you may have to do an extra 2, maybe another extra 2. So whenever you do IRR, at least have space for 8 columns. Have space for 8 columns. Open 4 columns. Year cash flow, PVF, DCF. Year cash flow, cost of equity as per realized yield approach. Realized yield approach. Year cash flow, PVF, DCF. PVF, DCF, and extra 2 more columns. Extra 2 more columns. Every 2 columns will give you one more NPV. So I need one positive, one negative NPV. Year 0. Year 0. What is the investor paying today? Negative 1000. He is paying this negative 1000. 1 to 5 years. 1000 into, they said dividend of 10%. Ideally, this 10% is on face value. I have no information on face value, so I'm taking 1000 into 10. It could be in the end 100 into 10% also, or 10 into 10% also, because it all depends on what is the face value of the instrument here. Face value detail is not there. 100 rupees I get at the end of 5 years. 128. Now what rate do I discount? Ideally they'll give a table below it, but in case I want to do 10% is dividend, along with that I'm getting something extra here. What is that extra? 128 rupees extra. So maybe I'll try at 12%. I get positive, negative. I increase the rate further or reduce the rate further. 10% is the dividend income already there. On top of it, some extra income you are getting in the form of capital appreciation. So maybe final answer is 12, 13, 14, somewhere around that. 12% if you do exactly 0 you are getting in this question. This is not mandatory. Exact 0 you are getting. If you get exact 0, answer is 12%. It ends there. Answer is 12%. Exact 0 we are getting, and that is IRR of the investor and cost of equity of the company. Cost of equity of the company. This is second way of calculating cost of equity. Then comes the third way. Question 6. Calculate the cost of equity of H Limited, whose risk-free rate of return equals 10%, beta equals 1.75, return on the market portfolio equals 15%. Now, the first approach which we did is useful only for companies paying dividend. Practically, there are a lot of companies which don't pay any dividend. If you're not paying any dividend, that formula 1 will not help me. D1 by P naught and all I cannot do. which is where this formula came called a CAPM approach. Very simple formula. Now, right? Cost of equity under CAPM. Cost of equity under CAPM is equal to RF plus beta into RM minus RF. RM minus RF. RM minus RF. RF plus beta into RM minus RF. RF is risk-free rate is 10. I'll explain the logic also. RF plus beta into RM minus RF 10. What is the beta? 1.75. RM 15%, 0.15. Yeah, this let me keep it as decimal itself. 0.10. 0.15 minus 0.10. 18.75%. Now, logical formula is very simple. Beta basically measures risk of a security. High beta, high risk, high cost of equity. Low beta, low risk, low cost of equity. Why high risk, high cost of equity? Because cost is equal to return of the investor. Cost is equal to return of the investor. If something is high risk, you need high return as an investor. Something is low risk, you need low return as an investor. High risk, high return. Low risk, low return. Logic is very simple. So high risk, high return, low risk and low return. So if risk is on the higher side, I need higher return. If risk is on the lower side, I need lower return. Now the only thing is, questions sometimes will use the word risk premium of market. The word used is risk premium of market, which means RM minus RF directly. The term risk premium of market means RM minus RF directly. RM minus RF directly. Instead of using the word return of market, they'll say risk premium of market or return premium of market. Okay, we are done with cost of equity discussion also. Cost of debt discussion got over. Cost of equity broadly is this. If I put it in the chart, it is very easy to understand. Dividend paying company D1 by P naught minus F plus growth rate. Non-dividend paying company RF plus beta into RM minus RF. Realized yield approach IRR of the investor. These three only we have done. The other two may come in some other question. Earnings based approach, I don't think I have in the question list, and I normally don't follow it also unless the question specifically says earnings based approach. Earnings based approach means first formula, dividend paying company formula. Instead of using the word D1, you will have to use the word E1. E1 by P naught minus F plus growth rate, and based on P, you may see it in some question. Now you will understand this chart really well. So that's why I don't discuss concept. I prefer to do questions, because if I discuss concept and I say this is what you have to do, you will not understand. But if I discuss questions and then I discuss the chart, you may understand. I may not discuss the charts also fully, but if you see the charts after the chapter is over, this entire cost of capital structure chapter or cost of capital chapter will get over in 4-5 pages. You go through all the charts, you will understand whatever we have done. Now I go to retained earnings. Now what is retained earnings is, a company is earning profits. I have a choice whether to give dividends to you or I retain it in the company. When I retain it in the company, there is a price I have to pay for that also. You cannot say that it is free money, because whenever I retain something, you will expect something extra from me in future. So if company says I will retain 10 lakh of your profits and don't pay dividend and not pay anything extra in future, as a shareholder I'll say give back the money. If you're not going to pay anything extra in future, you give back the money. Why are you retaining the money with yourself? So retained earnings also has a cost. KR is equal to KE. KR is equal to KE, cost of equity. Because what is KE? What an equity shareholder want. What is KR? Again, what an equity shareholder want, with only two exceptions. First exception is flotation cost. Flotation cost should not be deducted in the formula. That is, P naught minus F will not come. And second is something called as personal tax adjustment. What is that? We'll see in the question. Go through this question. Go through 7. Okay. While Limited retains 7 lakh 50 out of its current earning, expected rate of return to the shareholder if they had invested the funds elsewhere is 10%. To put it simply, return of the equity shareholder or cost of equity. Cost of equity is 10%. Brokerage is 3%. Technically, a flotation cost kind of an adjustment. And shareholders come in 30% tax bracket. Personal tax rate is given. If personal tax rate is given, then this adjustment will come. All right. KR is equal to KE into 1 minus personal tax rate into 1 minus flotation cost percentage. 1 minus personal tax rate into 1 minus flotation cost percentage. Now, what is the logic is very simple. Cost of equity, I want 10% return. But in the 10%, I have to pay some taxes and I may also incur flotation cost whenever I'm investing in the company. The company may incur flotation cost. So, KE will be higher than KR. KR doesn't have concept of personal taxes because I'm not paying anything to you. When I don't pay anything to you, there's no concept of tax payment at your end. Also, no concept of flotation cost. So here you write 10 into K is 10. 10 into 1 minus zero point 0.3 personal tax rate. 10 into 1 minus zero point 0.3 personal tax rate into 1 minus 0.03. In case only flotation cost is there, formula is KR is equal to D1 by P naught plus growth rate. No minus F. D1 by P naught minus F will come for KE. D1 by P naught, only by P naught will come for KR. Into 1 minus 0.03. What's the answer you get? With this, the discussion on cost of equity also gets over. Now comes cost of preference discussion. Cost of preference is same as cost of debt. Cost of preference is same as cost of debt. You can have redeemable, you can have irredeemable and convertible. Let's look at question 8. A company issues 10% irredeemable preference share. Irredeemable preference share. Face value of the share is 100, but the issue price is 98. What is the cost of preference share? Cost of preference share. Irredeemable preference share. Redeemable, we have two category. First question is on irredeemable. The same formula. Let's get to the formula here. Cost of preference. Cost of preference is equal to preference dividend divided by net proceeds. Preference dividend divided by net proceeds. If it's redeemable, preference dividend plus average other cost divided by average funds employed plus average. When it goes to irredeemable debenture, it's interest after tax by net proceeds. Interest. What is net proceeds? What we collect today. Net proceeds is what we collect today. How much dividend I have to pay? Face value is 100, so 10. Net proceeds is what we collect today. What are we going to collect? 95 into 100 to express in percentage. 10 point. That's all. Rework I'm not doing. Okay. It will be divided by 105. 10 by 95. Go through this. This is a very good question. Go through 9. Excellent question. Okay, a company issues 15% convertible debenture of 100 each at par with a maturity period of 6 years. On maturity, each debenture will be converted into two equity shares of the company. It will be converted into two equity shares. Risk free rate is 10%. Risk premium, market risk premium means RM minus RF is 18, beta is 1.25. Company has paid dividend of 12.76. 5 years ago, it paid a dividend of 10. Flotation cost is 5% of the issue amount. 5% preference share of 100 at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6%. Let me quickly close this. This is easy. The difficult part is the debenture here. Cost of debenture using approximation method. Approximation is formula. YTM method. YTM is IRR, yield to maturity method, to calculate cost of preference. So first let's close cost of preference. What we are going to do is we are just going to write year cash flow PVF DCF. If you have to use formula is preference dividend plus average other cost divided by average funds employed. What rate will I use? Mostly either of them, 3, 5, 5, 6, 7, something they have given. Somewhere around this you will get the rate. 3 and 5 is the rate we will use to get to the cost of preference. Mostly cost of preference will come from 3 and 5 percentage. Somewhere in between it will be. The issue is with the cost of debenture, which I'll explain as we proceed. Working note 1, cost of preference. Cost of preference using YTM method. Year cash flow PVF at 3%, DCF PVF at 5% and DCF. 3% and DCF, 5% and DCF. Year 0, 5% preference share of 100 each at a premium of 10%. Issues at a premium of 10%. The company issues, from there you have to read, and then issues each at a premium of 10%. Redeemable at par. Redeemable at par. Flotation cost is 6% of the issue amount. So year 0, 110 minus 6%. This 6% can be on face value also, but here it's very clear of the issue amount. 110 minus 6%. This is what I collect today. How much? 103.4. Every year I have to pay something. How many years is the life? 1 to 10. How much dividend we have to pay? 5 negative. 1 to 10 negative 5. No tax impact and all. 1 to 10 negative 5. At the end of year 10 we have to pay. That's all. We are not doing anything beyond this. You PVIFA, FA is annuity factor. You can use the annuity factor, and PVIF is the normal factor. So we will use these four numbers and get one positive NPV, one negative NPV, and that will give us the cost of preference. Clear? Any doubts on this? No need to do the IRR part analysis and all. YTM means yield to maturity, or IRR method. Now comes the cost of debt. Let's write the formula. Cost of convertible debt is equal to interest after tax plus redeemable value minus net proceeds by balance life, divide by redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. Now interest part is very simple. Net proceeds part is also very simple. The trickiest part here is redeemable value. Redeemable value. Let's do first discussion on redeemable value and then we leave some space and come down. Redeemable value is divide into two. Redeem as debt, convert into equity. Redeem as debt, convert into equity. Redeem as debt. Redeem as debt. Have they given any redemption data saying that this will be redeemed at this price? Anything mentioned? Anything mentioned on redemption clause? Nothing is mentioned. 100. 100. Convert into equity. I'll convert this into two shares, but into what price is the problem? Two shares into what price is the problem? Now, how do I get the price? Let's understand here. It says on maturity, each debenture will be converted into two equity share. When is the maturity? 6th year. I need the 6th year price. The problem which we did sometime back, there they gave the price today, and then I said add 4%, 4%, 4%, and you got the answer. Here, I don't know what is the price today. So first we'll try to get what is the price today. Leave some line, come down. K is equal to RF. What is the use of K and all you'll understand. RF plus beta into RM minus RF. Very good problem. RF plus beta into RM minus RF. Give me the numbers. What is the RF? 10, 0.10, beta 1.25. RM minus RF is directly given. Market risk premium is RM minus RF 0.18. Get the K number. 32 point. Clear? Another formula for K is D1 by P naught plus growth rate, right? D1 by P naught plus growth rate. Growth rate comes this side. KE minus G is equal to D1 by P naught. KE minus G is equal to D1 by P naught. P naught comes this side. P naught is equal to D1 by KE minus G. This is Gordon's formula of valuation. D1 by KE minus G. Now with this I'll get P naught. Once I get P naught, I will say add 5-6% every year and then get the price at the end of 6th year or whatever year we want. Now in order to do this also, I need growth rate. Growth rate here, they said company has paid a dividend of 12.76 per share. Paid a dividend means that is D0. Paid a dividend is 12.76. 5 years ago it paid a dividend of 10. Now for calculating growth rate, our formula was ROE into retention ratio. This is one formula. Second logic is, in the past, my dividends were growing at 5%, which means in future also it will grow at 5%. In the past, dividends were growing at 2%. It will grow at 2%. For calculating growth rate, we technically have two formula. One is based on earning ability, which is what I used in another formula. Second is based on past history. Based on past history. If you know the past history, past is a reflection of the future, or whatever has happened in the past will happen in future. So using the past data, I'll calculate the growth rate using the past data. So now leave some space again. Dividend today 12.76. 5 year back 10 rupees. 5 year back is 10 rupees. Dividend today is 12.76. 5 year back is 10 rupees. This is like present value. This is like future value. I'll explain first, right? Present value and future value. Whenever you have two numbers, the earlier number is called present value, the later numbers is called future value. So today we are 12.76 is present value if you compare today with a futuristic value. So 12.76 I'm comparing with 10. 10 is present value. 12.76 is future value. Now write future value is equal to present value into future value factor r comma n. Future value factor r comma n. This is time value of money formula. Future value is equal to present value. Whenever you have two numbers, the earlier number 2025 number will be present value if you compare 2025 with 2030, and 2025 will be future value if you compare 2025 with 2020. If you compare with an earlier period, today is called future, and if you compare with a later period, today is called present and later is called future. So future value is 12.76, present value is 10, r comma 5. 5 is the time period. FVF r comma 5 is equal to 1.276 r comma 5. That is 5-year future value factor. A 5-year future value factor. Now if you look at in the table, this is the 5-year factor. At 1% it is 1.051, at 2% 1.104, 3% 1.159, 4% 1.217, 5%. So 5% and 5 years. 5% and 5 years. So historical growth rate is 5%. Historical growth rate is 5%. 5-year, they have given 5-year factor, 6-year factor, 7-year factor. I don't know why they gave 6 and 7, just to confuse us. We just wanted 5-year because they gave 5-year dividend history. The dividend history is for a period of 5 years. So 5-year back, dividend was 10 rupees. Now the dividend is 12.76. So I keep increasing. Or in the calculator also I could have tried it, but with this table itself I get it now with the table. So from the table I find, right, FVF of 1.276 correspond to 5 years and 5%. 5 years and 5%. So growth rate we have calculated. Excellent question. Growth rate we have calculated. Whatever I did till now, entire thing gets revised here. 5% is the growth rate. I come back here now. D1 means next year dividend, 12.76. Next year is extra 5% growth, divided by 0.325 minus 0.05. This will give me today's price. First get the today's price, 2 decimal answer. How much? Divide by 0.275. 48.72. Now this number, that first question we did was given directly as 20 rupees. Here they made it so complicated and told us to do all this extra analysis. Now in the calculator, what we will do is, I want to into something, 48.72 in the calculator plus 5% for 6 years. 48.72 plus 5% for the first year, plus 5% for the second year, third year, fourth year, fifth year, sixth year. Keep adding 5 percentage for 6 times. Second year, third year, fourth year, fifth year, sixth year. 65.29. $130.58. So instead of giving you the base price directly, I wanted to complicate it by giving you the KE information using CAPM, growth information using past data, then you use the KE formula to get the price today, and then keep adding the growth. Any doubts on 130.58? Any doubts on 130.58? I'll repeat again. First I had to use the CAPM formula, get the KE, then use the KE formula to get the price. For the price calculation, get the growth rate using the past data. Once the price is calculated, keep adding 5%. Now let's get back here. What the interest the debenture is going to pay? 15 into what is the tax rate? 15 into 0.4, sorry, 0.6. 15 into 0.6. Redeemable value is 130.58. Net proceeds, it's not 100, read it carefully. 100 minus flotation cost, 95%. No? 6% was for preference. 95, 95. Life is 6 years. Balance is just a formality. This part was the critical one. The critical part was only that. Balance is just a formality. I'm not even interested in the final answer. This is what I wanted to explain. Any doubts here? So why we are doing all of this is to finally calculate WACC. What is WACC? Is single cost for the entire capital structure of the company. Let's analyze WACC now. Let's come to this. Question 10. Go through the question. Okay, now let's analyze what is WACC. WACC is single cost for the entire capital structure. We have to calculate cost of equity, we'll have to calculate cost of debt, we'll have to calculate cost of preference, cost of retained earnings, sometimes term loan will be there. All the cost you calculate and get a single cost. What is single cost is weighted average. So technically this segment which I'm doing is just waste of time. If you are very clear on the earlier part, this is just waste of time because getting the individual cost is very critical. After that, it is just doing weighted average. So technically, again, major chunk of time will get spent on how do I calculate cost of debt, cost of preference, cost of equity, and then doing a weighted average. For doing weighted average, we have a weighted average format, which I'll discuss as we proceed. So here in this question, we have four forms of capital. There is an equity capital, there's a retained earnings, there's a preference share, there's a debenture. For all the four, we will have to calculate cost. So let's first calculate each of that. Once all the four is calculated, we'll do weighted average. Working note 1, cost of individual components of capital. Working note 1, cost of individual components of capital. Of individual components of capital. Cost of equity is equal to, some of them are going to be very simple, some could need extra explanation. Cost of equity, which formula will we use here? D1 by P naught minus F plus growth rate new issue priced at 125 will be fully subscribed. Flotation cost is given. Dividend at the end of current year. At the end of current year is a futuristic data, so I take it as D1. So write D1 15. P naught is 125 minus 5. Growth rate, ideally, like the last question, they should have given a table. I would have framed the question, I would have missed out the table. How will you do? It says dividends have increased from 10.6 to 14.19. 10.60 is present value, 14.19 is future value, and you would have done future value is equal to present value into future value factor r comma n. Our future value is equal to, somewhere you would have done that. Assuming you had the data, you get the growth rate as, take the growth rate. Growth rate is coming as 6%. They should have given you the table, okay? Table, I missed it out in the question. Growth rate is 6%. How will you get the growth rate? Using the formula which we did in the previous question. So write growth rate as 6% plus 6% and get me the cost of equity. 18 point. Growth rate number, ideally the table should have been there below the question. Or they may not give the entire table, they may give say future value factor 5% comma 6 years, 4% comma something they'll give and will help us in calculating this. 18.5%. Then cost of retained earnings. Retained earnings. See, KR is equal to KE in case flotation cost was not there, personal tax is not there. Personal tax data is not there, but flotation cost is there. Repeat the same formula without minus F. Without minus F. D1 divided by P naught plus growth rate. That's all. 15 by 125 plus 0.06. 15 by 125 plus 0.06. 18. Retained earnings will be slightly lower than the cost of equity. It will be slightly lower because flotation cost issue is not there. The third form of capital is preference. Cost of preference. Read question and tell me, is there any information on life? Any information on life? Life of preference share. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. How much is the preference dividend? 15% preference share with a face value of 115. Net proceeds is what will you collect today? 105 into 100 to express in percentage. 14 point. Cost of preference, preference dividend by net proceeds. Clear? Net proceeds means what you can collect today. What is the money going to be collected? Last is cost of debenture. Is there any information on life? Yes. So use this formula then. Interest after tax plus redeemable value minus net proceeds by balance life. Cost of debt is equal to interest after tax plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. Okay, now comes listen. Redeemable value, all that is fine. The issue is with the net proceeds here. What is the issue? I'll explain. It says company proposes to issue 11-year 15% debenture, 11-year 15% debenture, but the yield on similar maturity and risk classes 16%. What is yield on similar maturity and risk classes? ICICI, SBI, both are similar because the risk is very less in case of an SBI bank as well as an ICICI bank. If you create an FD in SBI or ICICI, they are very good banks. Mostly they will not default and all. So our rate of interest of both the banks will be very close to each other. So here similar maturity and risk class, others are paying 16% and I am planning to pay only 15%. If this information on yield on similar maturity and risk class was not given, my issue price is at par value. But because they have given, I have to calculate the issue price. Now, how do I calculate the issue price? You'll understand as we proceed. It says compute market price of debenture as per what? Approximation method. If this line was missing, then I would have done year, cash flow, PVF, DCF, and the bond every year interest discounted at 16%. You are paying 15% and you will discount this at 16%, and this will give you the value of the bond or the issue price of the debenture. I see I have used approximation method. What is approximation method? Is using the formula. Now write K is equal to D1, right, K is equal to D1 by P naught minus F plus growth rate. K is equal to D1 by P naught minus F plus growth rate. Using this logic, a shortcut formula will come for debenture. KD is equal to I1 by P naught. No concept of flotation cost or growth rate in the valuation of the bond. I'm just valuing the bond using this formula. I'm not calculating cost of debt. To put it very simply, P naught is equal to I1 divided by investor yield. Cost of debt is investor yield. P naught is equal to I1 divided by investor yield. If I am paying 15% and you are needing 16% yield on similar maturity, so write 100 into 15%, and people want 16%, the issue price will be little less. 100 into 15% divided by 16%. What is the price you get? If shortcut was not to be used, year 1, 2, 3, 4, 5 till 11 years, you have to write the interest every year, principal value every year, and discount it at 16%. Discount it at 16%. To put it very simply, the logic is if I meet your expectation, which is if I pay 16%, I can issue it at par value. If I meet your expectation, I can issue it at par value. If I don't meet your expectation, I have to issue it at discount. And if I exceed your expectation, that is I pay more than 16%, I'll issue it at premium. I'll issue this at premium. So now my issue price will be 93.75. Issue price will be 93.75. Go back to the formula. Interest after tax. Interest after tax. 100 into 15%. What is the tax rate? So into 65%. Redeemable value 100. 93.75 minus, there is a flotation cost given in the question. What's the flotation cost given? Now this 2% can be taken on face value because it just says 2%. It is not very clear. It can be on face value. It can be on issue price. It's an assumption based area. Flotation cost can be on face value can be on the that is, you can take it as 2% of 100 rupees, or you can take it as 2% of 93.75. I don't know what is there in the answer. I'll take the same answer, same assumption. So the assumption here is 2% on face value. Take it on face value, okay? So 93.75 minus 2. Divide by 11 years. Get me the cost of debt. After all this is done, then comes the main calculation. Ten point. Any doubts on this? I don't want to spend much time on this. One important concept was, if they give yield on similar maturity and risk class, you will have to value the bond to calculate the issue price. Valuation can be shortcut. Shortcut is very simple, using the formula of KE, or using the formula of valuation of perpetuity. In time value of money, you could have learnt about valuation of perpetuity, where we use the formula called perpetuity amount divided by investor expectation. What is perpetuity amount? Is every year the bond will pay 15 rupees and you are needing 16%. So 15 by 16%. Next, computation of WACC. 6 columns. Source, cost, weight, 2 subcolumns, and then product, 2 subcolumns. Source, cost, weight, book value, market value, product, 2 subcolumns, book value, market value. Question has asked for WACC using both approaches. Some question will ask only one. Source, cost, weight, product. The logical part is on source and cost, which we have done. Book value, market value, all this is just multiplications task. Now write 4 cost. We have equity 18.5%, retained earnings 18%. All this we have calculated. Preference shares. How much was the preference? 14.29%. Debentures total. The major chunk of the time will get spent on only source and cost, and calculation is where, when we do, it is taking some time, but the main concept is getting source and cost. Book values are given in the question, copy paste. 1 crore 20 lakh, 30 lakh, 9 lakh, 36 lakh. Market values are also given. Listen, there is no separate market value for retained earnings. Market values, equity and retained earnings together. So this, I have to bifurcate between these two in this ratio. I have to bifurcate between the equity and retained earnings in the ratio of their book values. In the ratio of their book value, that is 4:1. You will have to split 2 crore in the ratio of 4:1. Some question ICI doesn't split. Reason is very simple. In case both are same, that is cost of equity and cost of retained earning is same, whether you split and then do multiplication or you don't split and do the multiplication, both are same, because it is going to be multiplied with the same cost of equity is same, cost of retained earnings is same. 2 crore in the ratio 4 is to 1, 1 crore 60 lakh, 40 lakh, 10 lakh 40, 3375. Column 2 into column 3 is the product, column 2 into column 4 is the product. Do the multiplication. 18.5 into 1 crore 20 lakh, 18.5 into 1 crore 20 lakh, 22 lakh 20,000, 5 lakh 40,000, 128610, 394 200. Keep multiplying. In case you find any calculation error, then let me know. Do multiplication and then put a total. These are your numbers. Morning. And once this is done, we'll calculate WACC. First put the totals. This step which I'm doing is just waste of time technically. One question only I'll do this step. Balance question. I'll just focus on the source and the cost part. And wherever if some discussion is needed, we'll do. Otherwise, this is the main step. The main step is getting source and cost. This is just multiplication. Entirely calculators work. No logic, nothing needs to be used here. Once you are done with the multiplication, below the table, done with this calculation, below the table, right? WACC, WACC based on book value, WACC based on book value, sum of product by sum of weights. $32, 82, 810 divided by 1 crore 95 lakh into 100 to express in percentage. Tell me the answer. 16.83%. Similarly, WACC based on market value. 41, 98, 179 divided by 2 crore 44 15. How much? 17 point. Any doubts on this? This whatever I did, maybe I spent some 10 minutes on the later part of the discussion, but that's just waste of time. We may not repeat this calculation again. If needed, I'll do, but otherwise my main focus is source and cost only. And that you do it correctly, balance is just a formality. Any doubts on this? Can you proceed? Clear? Let's come to 11. Go through the question. Okay, I don't see anything new here. One adjustment is there. You may make a mistake. That's okay. I give you exactly 5 to 6 minutes. You do at your end. I may start doing it in the screen in 2 3 minutes, but don't refer the screen. You start doing it. It's not WACC. It's just calculating five cost. You keep doing it. Refer the screen after 2 3 minutes if you get stuck. These should be your numbers. In case any calculation errors are there, let me know. First is cost of equity, RF plus beta into RM minus RF, 18.32, straightforward. I don't see any confusion there. Any doubts on 18.32? Second is cost of preference, preference dividend plus average other cost divided by average funds employed. Preference dividend is 15% of 100, 15 rupees. Average other cost is redeemable value is 100 minus net proceeds is 150. Today's price is 150. So net proceeds is, assuming I make an issue today, I'll make it at 150 rupees. Assuming I make an issue today, I'll make it at 150 rupees. So 100 minus 150 divided by 8 years, divide by 100 plus 150 by 2. Are you getting 7%? Okay. Then cost of debt. Third is your convertible debenture. Similar to the first question which I did on a convertible debenture. Today the price is 25. Add 6%. If you add 6% for I think 6 years, you'll get some 35 point something. And you get 141.84. And finally cost of debt is 13.83%. Yep. 5 years. Okay, okay, sorry, I did not see this. Okay, so 5 years then, 5 years. Tell me the numbers then. Sorry, it's 5 years. Sorry, my mistake. 8, 2, divide by 5 years then. Divide by 5 years. Okay, yeah, it was issued on 1/4/2023 and today we are in 31/3/2024. Balanced life. The formula is always balanced life. So whatever is the balanced life needs to be taken. So this number is, how much the number you get here? 16.52 divided by 116.91, 14 point. I'll repeat again. The initial period was 6 years. What matters is the balanced life because we are calculating today. So today when we do the calculation, balanced life is only 5 years. And today the share price is 25. Today the share price is 25. From there we added 5 years price and divide by 5 years. Cost of retained earnings is same as cost of equity except for two situations: personal tax rate and flotation cost. Flotation cost information is not there, but personal taxes are there. So you have to do into 1 minus personal tax rate. Personal tax rate is 20% in this question. You get 14.656. Term loan, if no other information is there in a debenture or in a debt instrument, cost of term loan is equal to interest rate into 1 minus tax rate. That's all. Very simple answer. 11 into 1 minus 0.25 corporate tax rate. 11 into 1 minus 0.25. No need to do any other. Even for a debenture, if they don't give any other information on a debenture, interest into 1 minus tax rate. Yeah, 5-year calculation. Any doubts on this? Go through 12. Capital structure of Samyukta is as follows: 12% debenture is there, 14% preference is there, equity is there, additional information is given, WACC using market value weights. So first we have to calculate cost of individual components of capital. Three forms of capital is there: debenture is there, preference is there, and equity is there. Once that is done, I'll also do WACC, where a small discussion is needed, not a very important one, but we'll do WACC as well in this question. Let's start. Working note 1: cost of individual components of capital. Components of capital. First one is debenture. In case of debenture, is there information on life? 5 years. So cost of debt is equal to interest after tax plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. Face value 100 into rate of interest 12% into 75%, 1 minus tax rate. Is there a redeemable value given? Redeemable at a premium of 6%, 106. Net proceeds means what you can collect today, assuming I issue at current market price of 115, assuming I issue it at 115, I make an issue at 115, so I'll collect 115. Flotation cost I assume is 5% of 115. Flotation cost is 5% of 115. You can also take 5% of 100 also. So minus 115 and 5% of 115. 5% of 115. 5% of 115. How many years is the life? 5 years. Denominator 106. 115 minus 5% of 115. 109.25. It can be taken on face value also. I don't know what is there in the answer. I'm doing it. We'll see later. Nine plus 9 minus, it becomes negative. 9 minus 0.65 divided by 107.625. Tell me the answer. Sorry, 7.76%. Any doubts on this? Next, cost of preference. This question has negative average other cost. There can be a possibility of negative also. Cost of preference. Preference dividend. Preference dividend plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. All that remains same. The question can make it complicated by saying that you have to do IRR method for cost of debt or cost of preference, which one of the exam question did. IRR means it will take a little bit more time. What is the preference dividend here? 100 purpose issued at a discount with a flotation cost of 5% on the issue price. Current market price is 108. It has a maturity period of 10 years. Little bit complicated example. I'll explain as we proceed. First is preference dividend is how much? Where is it? Okay, 14%. Okay, 14. Redeemable value 110. Net proceeds, my assumption It was issued at a discount earlier. I'm not bothered about what happened in the past. Today, I assume I'll be able to issue at 108. Today, my assumption is I'll be able to issue it at 108. Somebody says, no, no, today also you'll issue at 98. That's your assumption. I assume that it will be issued at 108. Again, the flotation cost will be there. Flotation cost will be there. Logic for flotation cost is when I issued last time, I had to incur flotation cost. Today also I'll incur flotation cost is my assumption. Answer can vary if the assumption is different. My assumption is I'll be issuing it at current market price of 108 and then incur the flotation cost of 5%. So net proceeds is 108, 5% of 108. Life is balanced life, 10 years. 13 point. Next, cost of equity is very simple. Quickly close cost of equity. You can refer the screen if you want, but that is very simple. 26.44%. Any doubts on this? Now, I'm not doing the full discussion on the WACC part. Once this is done, you'll do source, cost, weight, and product. Weight for debentures will be 3,50,000 divided by 100, which is the face value, into 115. Weight will be divided by 100, which is the number of debentures, multiplied with 115. This will be divided by 100 multiplied with 108, multiplied with 108 market value weights. This will be divided by 10 multiplied with 30, multiplied with 30. So cost of, okay, so this is ICI solution. They have taken little bit of different assumption. They have taken the issue price itself as 108 minus 2% of 108. That's an assumption based area. Doesn't really matter. We can't help it much. This answer is matching. This answer is matching. Here, slight bit of an assumption gap. The assumption gap is we have taken 108 to be the issue price directly. They have taken 108 minus 2% to be the issue price, and on that the flotation cost. Go through 13. These are typical exam questions. Okay. Capital structure of T Limited as on 1st April 2024 is as under: equity capital 10% debenture, 12% preference, risk free rate of return, beta return on market portfolio, equity shares have a current market price. This will help us in calculating cost of equity. Debentures are trading at a price of 80. Debentures will be redeemed after 5 years. Preference shares redeemable after 5 years. Company pays tax. Cost of debentures is to be calculated on yield to maturity approach, very clearly given. So 10 and 14% is given. Using that, we will do the calculation. And finally, WACC using market value weights. WACC is using market value weights. We will do the table alone for the cost of debt. We will not calculate the cost of debt fully. And they've asked us to do it under market value weights. It is kind of straightforward. Let's start. You can do on your own also, or do it along with me. That's your wish. Question 13. Cost of equity is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. 10 beta is 1.75. 12 minus 10. Give me the answer. 13.5%. Cost of equity is 13.5%. Cost of debt, we'll do the table, 6 columns. Source cost, weight, sorry, not source cost, year, cash flow, PVF at 10%, DCF, PVF at 14%, and DCF. %, DCF, and 14% and DCF. Somewhere 10 and 14 will help us in getting to the cost of debenture answer. Year 0, year 0. If I issue the debentures today, assumptions will be issued at the market price of 80. So year 0, negative 80. 1 to 5 years, 100 into 10% into 70%, minus 7, and at the end of 5th year, minus 100. Any doubts in this? 80 minus 7 and minus 100. This will give you the cost of debt answer. I'm not doing the cost of debt part. Not doing the cost of debt part. Any doubts on this? Then cost of preference. Preference dividend plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. How much is the preference dividend? 12% preference share capital, 10,000 shares of 100 each, so 12. Redeemable value is 105. Net proceeds is 104. Life is 5 years divided by 105, 104 by 2. 12 plus 0.2 divided by 104.5. What's the answer? 11.67%. Any doubts on this? Beyond that, we are not doing it. You will put it in source, cost, weight, product. Weight will be market value weights. What is market value? Number of shares into the market price, number of debentures into the market price, and number of preference shares into the market price. Any doubts on this? Go through 14. Okay, let's discuss it. Calculate the WACC using the following data by using market value weights, equity shares, reserves and surplus, preference share, debenture, market price data is given, debenture, preference, equity, additional information, 100 face value per debenture, redeemable at a premium of 10%, 10% coupon rate, 4% flotation cost. Then again for preference share, equity. To calculate the cost of debt and preference, take the average of the respective cost using YTM and approximation method. So they can make it even this much level of complication in exam if they want, where you have to do formula, then you have to do IRR, then you take average and then do the WACC calculation. We are obviously not going to do the approximation method in detail. We are just going to do first the formula based method. Formula based method will do it fully. YTM method will just do the table and then close it. For doing YTM method, ideally the question will again give you two rates. Okay, they'll give you two rates, and if they don't give you two rates, whatever we get approximation, we start with that. Increase the rate, reduce the rate. One positive NPV and one negative NPV. Now, one more thing which should have been added in the question is for doing WACC. In this question, ICI didn't want us to do this. That is, when you do market value weights, you are not required to separate the market value of equity into market value of shares and reserves while calculating WACC. Also, there is no need to calculate the cost of retained earnings because ICI just went with cost of equity as it is. They did not do retained earnings analysis itself. This should have been added in the problem. I've just added that in the question as a modification. Okay. When you look at the ICI problem, this will not be there. So again, we have to do cost of debt, cost of equity, and cost of preference. Almost similar to one of the earlier question we did. Let's start. Cost of equity. Cost of equity. No retained earnings calculation. Cost of equity. Cost of equity is equal to D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. D1 is 2.18, 2 plus 9% growth. P naught is 27 minus 4.5, growth is 0.09. 27 minus 4.5, 0.969, 18.69%. 18.69%. Cost of equity. Cost of retained earnings is not needed if I was to calculate it without minus flotation cost. Without minus flotation cost, we would have done. Cost of debentures. Cost of debentures. First, we will do the approximation formula. Interest after tax plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. 100 into what is the 100 into 10% into 75%. Redeemable value is redeemable at a premium of 10%. Redeemable at a premium of 10%. Net proceeds is assuming it is issued at the current market price of 105, 105 and 4% of 105. 4% of 105. Life is 10 years divided by 110 minus 110 plus 100.8. What's the final answer? Final answer. Give me the final answer. 7.99. Okay, 7.99%. Any doubts on this? Along with this, you'll have to do the YTM method. For YTM, we may start with 8% if they don't give the table. If they don't give the table, 8% you start, you get positive, negative, then get one more rate, one positive, one negative, and then you complete the answer. Any doubts on cost of debenture? Cost of preference? Cost of preference? All these are typical exam question. I've pulled out most of the MTP, RTP questions only in this, so that you get a comfort that exam questions will be like this only. Preference dividend is 12 plus redeemable at par 100. Issue price is 115 minus 2% of 115. Life is 10 years. Okay, 10. Denominator is 100, 112.7. It will be a very small cost because negative average other cost. 10 point. 10 point. Okay. Check again maybe. Okay. Yeah. 10 years. 10.73 divided by, is the numerator 10.73? 0.35. Okay. Any doubts on this? Then you'll have to put it in the WACC format where market value weights. Ideally, I should split the market value of equity into market value of, that is value of equity and reserves and surplus. I say I has not done it. That's why I've altered the question. Any doubts on this? This is, then you'll have to do the YTM method. YTM, one positive, one negative you will need. Go through 15. Go through this complete part 1. Part 1 is WACC based on existing capital structure, around 6 minutes for you. 5 to 6 minutes, nothing much for me to be explained there. You try doing it. If you get stuck, we'll see. Part 2 is where I want to spend time. 5 to 6 minutes for you. Just one explanation. In case they do not give any extra data, for example, preference, no extra information. Cost of preference 11.5 as it is. Debenture, no extra information. Interest into 1 minus tax rate. So, no extra information, cost is as it is. No change in amount, take the amount as it is, close it. Complete till the WACC part. You keep doing it, I'll be back in 2 minutes. Okay, I will quickly discuss it. If you have completed, great. Otherwise, you can check the numbers. Cost of equity will be, it says, will pay a dividend of 15 by 300 plus 5%. All put together, I think it is 10% is the cost of equity. Preference is 11.5 as it is. Debenture will be 6.5% multiplied with these are the weights: source, cost, weight, and product, and you will get the answer as 9.43%. This is on the existing capital structure, which is where I didn't want that much time to be spent. I want to spend time on the later part. Any doubts on this? Any doubts on 9.43%? Now comes the later part. Calculate the new WACC if the company raises an additional 50 lakh debt by issuing 10-year 12% debenture, by issuing 10-year 12% debenture, but the yield on debentures of similar maturity and risk classes 13%, flotation cost is 2%, face value is rupees 100. This will result in increasing the dividend to 20, growth rate unchanged, price fall to 250. Now, one practical angle is whenever I do a WACC, I've done. After that, you raise any extra money. Whenever you raise any extra money, the original three cost which we calculated, cost of equity, cost of debt, cost of preference, all the three can change, or some of them can change. For example, if you keep borrowing more and more, equity guys will feel it is risky. Even the existing debenture guy may feel it is risky. Preference may also feel risky. Because this new guy is coming in, no changes in cost of preference, no change in cost of existing debenture. What question could have said is, because the new guy is coming in, preference share price has gone down from 100 to 80. If it goes down from 100 to 80, there will be a change in cost of preference. Debenture price may go down, there will be a change in cost of debenture also. So there no changes are happening, but cost of equity will change, and there is a cost of new debenture. Old debenture is different and there's a new debenture. Next, rework scenario, right? Rework scenario. Rework scenario. Working note 1, in that, cost of individual components of capital. Individual components of capital. Now, four forms of capital are there. Cost of equity. Cost of equity is equal to D1 by P naught plus growth rate. What is the D1 number? 20. P naught is 250. Growth rate remains same. Growth rate is 5%. Cost of equity is undergoing a change. How much is the cost of equity? 13%. Cost of existing preference, in bracket, no change. No change. Same, 11.5%. If question wants, they can say there can be a change in this also by increasing price, reducing price. Cost of existing debenture, again in bracket, no change. Existing debentures were 6.5%, remain same. Cost of new debenture, cost of new debenture, interest after tax plus redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. Interest after tax, redeemable value minus net proceeds by balance life, redeemable value plus net proceeds by 2. The new debenture, we are going to pay interest of how much? Sorry, 12%. As I'm assuming the face value, okay, face value is given 100 only, face value is 100. 12 into 0.65, redeemable value is 100. Issue price, again I have two choices, okay. I'm going to do shortcut method. but I can do a detailed method also. I'm going to do shortcut method. Detailed method is also possible for us to be done. So shortcut method, now come down, issue price is equal to interest in rupees divided by investor expectation. Interest in rupees divided by investor expectation. 100 into 12%, but investor wants 13%. We'll have to issue this at little bit discount. The issue will happen at a discount. How much? 92.30. 92.30. Any doubts on this? I'll have to issue this at discount 12 divided by 13%, 92.31. Okay, 3076. Take it as 3131. So net proceeds is 92.31. I'm assuming 2% of face value. That's your assumption based area. That's your wish. Balance life is 10 years. Get the answer to this. Let me know what is the cost you get. 12 into 0.65, which is 7.8, plus 0.969 divided by 95.155. What's the answer you get? 9.2. Okay. Beyond this, you need not do, be in listen mode. Now you have to do the WACC calculation exactly like what you did earlier. Only add on will be this new debenture, which has a value of how much? 50 lakh. But one more caution, this 3 crore value can change. Why will it change? Because the share price has fallen to 250. Share price has fallen to 250. So the weights can also change. The weights can also change. So if you see here, originally we took 3 crore, but when I do this here, they have taken 3 crore. 3 crore is book value weights. If you follow market value weights, it will become 2 crore 50 lakh. Market value weights will become 2 crore 50 lakh. Maybe the answer is under book value weights approach. Market value weights, if you follow, the value will be what? 2 crore 50 lakhs. Clear? Any doubts on this? So be a little cautious about this, whether the question has set the approach. No, they have not told the approach. So if it's silent, you have two approaches possible. Either go with book value weights or market value weights. Here, these are book value weights. Share price was 300. 10 lakh into 300 is the market value weight, which is same 3 crore. 10 lakh into 300 is same 3 crore. So originally, I did not discuss book value or market value. Did not make any difference. But in the rework, it's your wish whether you want to follow book value or market value. Market value weights will, equity will be 2 crore 50 lakhs. Any doubts on this? Clear? Let's come to 16. Navya Limited wishes to raise. Okay, go through this. Go through this. Just give me a minute. There is some issue in the live online. Okay, let's discuss this question. Navya Limited wishes to raise additional capital of 10 lakh for meeting its modernization plan. 3 lakh available in the form of retained earnings. Following is the further detail. So whatever money is to be raised, they have given some mix. Cost of debt is given and cost of equity is also almost given. The data is given. First is pattern of raising the additional finance. That is how are we going to raise the money. Post-tax average cost of debt, then cost of retained earnings, cost of equity, and finally WACC calculation. This is not technically WACC, this is technically WMCC. What is WMCC? Is weighted marginal. Marginal means additional money. So now write pattern of raising additional finance. 10 lakh, 10 lakh split into 2. Debt, equity, debt and equity. Some mix is given in the question. What is the mix they have mentioned for? 40% debt, so 4 lakh. 60% equity, which is 6 lakh. 4 lakh and 6 lakh. 4 lakh and 6 lakh. Debt is further broken down into 10% interest, 1 lakh 80,000, and then 16% interest, 2 lakh 20,000. This equity will come in two forms: retained earnings, external equity. I already have 3 lakh of retained earnings, and extra 3 lakh will come in the form of external equity. 3 lakh and 3 lakh. 3 lakh retained earnings, 3 lakh external equity. Now, next is what is the post-tax cost of additional debt? No extra information. Cost of debt is equal to interest into 1 minus tax rate. Interest into 1 minus tax rate. So now write cost of 10% debt equal to 10 into 1 minus 0.5. 5%. 10 into 1 minus 0.5. Cost of 16% debt, 16 into 1 minus 0.5, 8%. Cost of 10% debt, cost of 16% debt. 5 and 8. And they want average. Average means weighted average, not simple average. This 5% we are going to pay on 1,80,000 and balance 8% will pay on 2,20,000. This is from that pattern. Pattern said 1,80,000 you will pay 10% interest, effective cost is 5%. 2,20,000 will pay 16% interest, effective cost is 8%. Average cost is equal to weighted average 1,80,000 into 5%, 2,20,000 into 8%, whole divided by 180 plus 220. 1,80,000 into 5%, 2,20,000 into 8%, whole divided by 180 plus 220. How much? 6.65%. Any doubts on this? Clear? Then cost of equity K is equal to D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. Dividend payout. So I am assuming it is getting paid now or somewhere. It is already paid out. We don't know. 2 rupees is D0. Growth is 10%. Growth is 10%. So 2 plus 10%. 2 plus 10%, 44 plus 0.10, K is 15%, KR also 15%, KR also 15%, and then we'll put source cost weight product, which I'm not doing. Source cost weight product will give you the answer. KR and K is same here. Ultimately, you'll have to put it in the same format. Here, when you do WMCC, here it's technically WMCC, there's no concept of book value, market value, because all are same. Because whatever money you are going to raise, that is called market value, and that is what you will record in your books of accounts also. If you are issuing it at 200, you will record it at 200. So there's no concept of technically difference between the two. Any doubts on this? Clear? Okay, now 17 is a very good problem. Some part of it may need an understanding of ratios also. So we will anyway try to do this question. It's a very good problem. It is a question on MCQ based. So MCQ based question, what you need to do is, whenever you do an MCQ based question, let's not read the question first. First, go through the requirements. Read all the 5 requirements. I'll do it together, okay? Which of the following is the best estimate of cost of equity is asked? Which of the following is the accurate measure of issue price of debenture is asked? Which of the following is cost of debenture using approximation method? Cost of preference using approximation method? Which of the following represents cost of marginal capital to be raised? Cost of marginal. So cost of equity to be calculated, issue price of debenture to be calculated, cost of debenture to be calculated, cost of preference to be calculated, and then WMCC or technically WACC. Now let's go back to the table. Let's read the question. Tiago Limited is an all equity company. All equity company means today it does only equity, engaged in manufacturing of batteries for electric cables. There has been a surge in demand for their product due to rising prices. Company was established 5 years ago with an initial capital of 10 lakh. Since then, it has raised funds by IPO, taking total capital to 1 crore, comprising of fully paid up equity share of face value of 10, undistributed reserves of 60 lakh. Company has been following a constant dividend payout policy of 40% of earning. Payout ratio is 40%. Retained earnings are going to provide a return on equity of 20%. This will help me in calculating the growth rate. Return of equity of 20%. Growth rate will be calculated using this. Current EPS is 20. Current EPS means today the EPS is 20. Prevailing P ratio is 15 times. Company wants to expand its capital base by raising additional fund by way of debt, preference and equity. This extra money which we are going to raise, for that they've asked WMCC only for the extra money, not the existing money, because existing only equity is there. Extra money is debt, preference and equity. Company wants to raise an additional fund of 1 crore 20. Target ratio of own funds to borrowed capital gearing. So this you will understand only if I had done the ratio analysis adjustment, but I'll discuss them next. Existing debt market are under pressure due to ongoing RBI action on NPA of the commercial bank. Okay, till this, let's calculate cost of equity. Let's just quickly calculate the cost of equity now, right? Cost of equity is equal to D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. Leave some 2 lines. Dividend per share is equal to earnings per share into payout ratio. Earnings per share into payout ratio. 20 into what is the payout ratio? This will ideally be D0 because it is current EPS is 20. Current EPS means today the EPS is 20. Assuming dividend is getting paid immediately, 8 rupees. 8 rupees will be D0. Growth equal to ROE into retention ratio. Growth equal to ROE into retention ratio. ROE is somewhere given in the question. 20%. Payout is 40, retention is 60. 12%. Price equal to EPS into P multiple. This you will learn in ratio analysis. EPS into P multiple. What is P multiple? Is price by earning. So you can write like this. P is equal to price by earning. Price by earning. 15 equal to price by 20. P multiple means price by earning. P multiple is nothing but price by earning multiple. So 15 equal to price by 20. You will get the price here. What is the price? 300. Let's now use it in the formula. 8 plus 12% divided by 300 plus 12%. $14.99. In case in the MCQ this choice is not there, maybe I'll take that 8 as D1 directly. 8 as D1 directly, D0, D1 in case if at all the MCQ's option is not matching. Clear? So 14.99, that is done. Part 1 is done. The question number 1 is done. Clear? Next comes the debenture analysis. Existing debt markets are under pressure due to ongoing RBI action in NPA of the commercial bank. Due to challenges in raising the fund, the company will have to offer the debenture at an yield of 9.5%. What is yield of 9.5%? Investor wants 9.5%. Coupon rate will be 8%. Issue expense will be 4% of the proceeds. Preference share will have a face value of 1000, offering a dividend rate of, this is important, preference will be issued at a premium of 5%, redeemed at a premium of 10% after 10 years at the same time at which debentures will be redeemed. So the life of the debentures is mentioned here. At the same time at which debentures will be redeemed. They give information there, and in the next information they are talking about life of preference as well as debenture. So it's a 10-year life. Now one is doing a shortcut approach. What a shortcut approach is? Interest in rupees divided by investor yield, which I think will not match in the given option. So accurate measure is you will have to do year cash flow PVF DCF, year cash flow PVF DCF, and get the issue price of the debenture. After the issue price of the debenture is got, cost of debenture is equal to interest after tax plus average other cost divided by average funds employed. Next working note, computation of issue price of debenture. Computation of issue price of debenture. In MCQ, I have clarity whether to do shortcut or this. If you do shortcut, you will not get to the options given there. What a shortcut is very easy. Interest in rupees divided by investor yield. Year cash flow PVF DCF. We'll have to value the bond. PVF at 9.5%. People want 9.5%. How many years is the life? It is not like that RBI example. RBI, there was an amortization where I had to do every year interest calculation separately. 1 to 10 years, one number, and at the end of year 10, one number. 1 to 10 and year 10. 1 to 10 and year 10. 1 to 10 is the face value given. 100. So 8 rupees and 100 rupees. Get the 10-year annuity factor. 1 divided by 1.095. Before you do the annuity factor, write the normal factor. 4035. How much? 6.279. 50.232. You can round off also, doesn't really matter. In the end, one of the option will be there. We will take that option. 90.58 I'm getting. Whichever option is very close to this, we'll take that as the issue price. In case there is a huge variation, then there is some calculation error. Two questions we have done issue price where very shortcut formula we did. Shortcut is interest in rupees divided by investor yield. Here shortcut will not work because it will not match with the given choices. 90.58. Next, calculate the cost of debenture. Interest after tax plus average other cost divided by average funds employed. Shortcut formula. Complete cost of debenture, cost of preference. Cost of debenture and cost of preference, please complete it. After 90.58, it should be very simple. Flotation cost is 4% of the proceeds. Proceeds means 4% of 90.58. What's the answer? 7 point. Is it matching any of the options? 7.64. Any doubts on this? So this is how your MCQ based questions will be there. It is nothing different from the normal questions. Only thing is makes it easier because we'll have choices. Assumption based answer can't change. Next, get the preference, cost of preference. Get cost of preference. Will not have the headache of assumption based answers here. %9.77%. Clear? Any doubts on this? Okay, the last part, I'm not going to do it fully. I'll give you the answer and all. You need to use the ratio analysis understanding. What you'll have to do is, in this 1 crore 20 lakh, I'll have to use the ratio called capital gearing ratio, which is called debt plus preference divided by equity plus reserves. This will tell how much extra money we are going to bring in the form of debt, how much money is going to come in the form of preference, how much money is going to come in the form of equity, and then finally do a weighted average. Now, what is the weighted average? Cost of equity is 14.99, cost of debenture is 7.64, cost of preference is 9.77. That calculation, in case you have to do an exam, it will take good amount of time. Even in class discussion will take time. Assuming you have to choose one answer, which one will you choose? There are four choices given. No need to do any calculation, no need to analyze itself, because it's weighted average of these three numbers. So somewhere between these three only the answer can be. The choices given are very bad choices. They should have given like 12, 11, something like that, and all the choices should have been between 7.64 and 14.99. Answer above 14.99 is not possible. Answer below 7.64 is also not possible. When you take an average of three number, it has to be between those numbers. So this is impossible, this is impossible, this is impossible. These three are impossible. So even without knowing what to do in exam, because that was the most trickiest part. So many a times in MCQ, what will happen is you can do something called as an elimination route. What is elimination? Is eliminating some of the answers. So I can go ahead and eliminate 17.16. I can eliminate 16.71. I can eliminate 16.17. Once I've eliminated these three, assuming you are not able to, assuming this was 11.25, then your choice, you choose one of the two. In case you are not able to do it fully, at least choose one of the two and then put a tick mark, rather than leaving. Anyway, MCQ will not leave in choice, but here no need to even analyze the full question, because students will try to analyze it. If you see the answer, there will be a detailed calculation. This calculation will take a lot of time in exam, and after that finally you get 10.52. Instead of doing all this calculation directly, I'll write 10.52. Clear? Able to understand this? In this question, there is no point in analyzing it further. Clear? In MCQs, this will keep happening. You can use some shortcut approach and then try to get the answer, technically called elimination route. I'll keep discussing this in other question. Done? We'll take a break now. Okay, we are almost done with the cost of capital chapter. I think I have two more questions. Let's quickly close them. Let's come to 18. Uh, go through the question. It's a slightly lengthier problem. Go through the problem. Okay. Toto Limited has the following capital structure, which is considered to be optimum. This word is very critical. The word optimum means any money I want to raise in future, I'll raise it in the same proportion. For example, today debenture 4 lakh 50, preference 1 lakh 50, equity 24 lakh, all put together is 30 lakh. So any money I want to raise in future, debenture raising will be 4 lakh 50 on a base of 30 lakh. The weights will be This is 15%, 5%, and 80%. So if I want to raise 1 rupee, 1 rupee would be raised as 15 paise, 5 paise, and 80 paise. This is the proportion. Company share has a current market price of 30. Dividend is 50% of 2023 EPS. EPS of last 10 years is given. The company can issue 14% new debenture. Today the debenture is 12%, but new debenture will be 14%. Whenever I want to calculate cost, I'll calculate using the new debenture rate only. 14% will be the rate we will take. Preference 12%. Debenture is currently selling at 99. New preference share can be sold. Calculate the after tax cost of new debt, new preference. They specifically use the word new debt and new preference. Even if they don't specify, it will be new debt and new preference. And ordinary equity, assuming it comes from retained earning. Then marginal cost of capital. Marginal cost of capital is whatever be the money to be raised. The weights will be 0.15, 0.05, and 0.80. 0.15, 0.05, and 0.80. In this proportion, the money will be raised. How much can you spend for additional capex before new ordinary shares are issued? And what happens if new ordinary shares are issued? You'll understand 3 and 4 as we do. Working note 1, computation of cost of individual components of capital. Computation of cost of individual components of capital. Cost of debt is equal to, is the information on life available? No. Interest after tax divided by net proceeds. Interest after tax divided by net proceeds. Interest after tax is 14% new debenture. So 14 face value 100 assumption. 14 into what is the tax rate? 1 minus 0.5 divided by net proceeds is issue price, assuming the issue happens at current market price. Assuming the issue happens at current market price, which is 99. The debenture is currently selling at 99. Divide by 99. 7.07%. Cost of preference. Preference dividend by net proceeds. The new preference will be 12% new preference share. The new preference will be sold at a price of 9.9. Okay, it says 9.9 paying a dividend of 1.25. Not sure from where 1.25 is coming, but it says 1.25 will follow 1.25. 12%, 1.25 is not fitting in, but they have given 1.25 paying a dividend of 1.25 per share. 1.25 divided by 9.9. 12 point. Cost of retained earnings. Technically cost of equity. That's technically cost of equity. Cost of retained earnings is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. The expected dividend next year is 50% of 2023 EPS. 2023 EPS into 50%. 50%. Price today is how much? Okay, it's given in the top 30.25. Growth rate every year, it's the same growth rate in this question. They have not given any table and all. Can you find out the growth rate here? 1.311 minus 1.18 divided by 1.18. 1.311 minus 1.18 divided by 1.18. What's the growth you get? Then try 1.456 minus 1.311 divided by 1.311. 11.06, then try 1.616, 1.456, divide by 1.456. 10.98. So basically it's 11%, up and down rounding of differences happening. It is 11%. Every year the growth is 11% in this question. Basically some year you get 11.0506. That's more of rounding of difference. Growth is 11%. 0.11. Growth is 11%. 0.05 plus 0.11, 0.16. 11% is the growth rate. Clear? Working note 2, computation of weighted marginal cost of capital. Marginal technically means additional source cost weight product. Copy the three things: debt 7.07%, preference 12.63%, retained earnings 16%. Now the cost, the depends on the weights. Weights depend on what we are raising. They have not given money and all. So the concept is very simple. Whatever additional money I raise will be in the same proportion. Weight of debt will be right 4 lakh 50 divided by 30 lakh, 0.15. Debt will be 0.15. Preference is 1 lakh 50 divided by 30 lakh, 0.05. 24 lakh by 30 lakh. That's all. We are not doing beyond this. Okay. Sum of product by sum of weights will give you WACC or WMCC, whatever name you want to call, because it's going to be the same proportion. Clear? Working note 3, possible capital investment with available RE, with available retained earnings. What is this? I'll explain. With available retained earnings, possible capital investment with available retained earnings. Available retained earnings. Now, what question says is, how much can you spend for capital investment before new ordinary share must be sold, assuming that retained earnings available for next year investment are 50% of 2023 earnings. See, whatever investment I want to do, 80% of that will come from retained earnings or from equity. And there is always a limit on the retained earnings. If you want to do 1 lakh investment, retained earnings could be available for that. But if you want to do 1 crore, 10 crore, 20 crore, 50 crore, retained earnings may not be available. So they are saying, how much can you invest with the available retained? How much can be spent before new ordinary share must be sold? In case you cross a limit, after that you have to issue fresh shares. Till some point, retained earnings can support your requirement. So till what point can retained earnings support is what we are required to calculate. Now write particulars amount, particulars and amount. Total earnings of 2023. In that only 50% is available. Total earnings of 2023. How many shares are there? 2 lakh shares into 3.023. 2 lakh shares into 3.023. 604, 600. Retained earnings 50%. 302, 300. Now, what this means is, if you want to do 1 lakh investment, 2 lakh investment, 3 lakh investment, all that is possible with retained earnings. Retained earnings is only 80% of investment. So below this, retained earnings is equal to 80% of investment. 30 to 300 is equal to 80% of investment. This will tell you how much investment you can do. Investment with retained earnings. 3 lakh 77,875. This much I can do with the retained earnings. In case I want to go beyond this, which is part 4 of the question, my WACC may undergo a change. Whatever WACC of calculated above will hold good till 377,875. Beyond this, what will happen is, same table you will have to recreate. We're not doing it. What will be the marginal cost of capital in excess of the amount calculated if you're going to issue new share at what rate? 22. If 22 is the issue price, in the denominator, here you will get 22. KR is not there. It is now KE, and KE will undergo a change. KE will undergo a change. It will not be 16%. So originally, if you see here, you get 14.492. Beyond this, if you go, the 16 changes to 17.87 and this changes to 15.988. Your cost will go up to 15.988 till 3,77,000 retained earnings will support, and my cost is only 14.49. Beyond that, I have to do fresh issue of equity share. When I do fresh issue of equity share, the issue price is on the lower side. So cost of equity is going down. Cost of equity is increasing and WACC is increasing. Any doubts on this? Clear? Can we proceed? Go through 19. Okay. I have a current debt equity ratio of 3:7, which indicates that in case I want to raise any money in future, I may raise it in this proportion or something else. The question says it is analyzing various proposal costing less than 25 lakh. Company will always raise the fund without disturbing its current capital structure. So ratio will be maintained as 3:7. If you raise up to 5 lakh, that is, project cost is up to 5 lakh, cost of debt is 10, cost of equity is 12. Weighted average will be 10 into 3, 12 into 7 divided by 10. 3:7 is my mix. 3 is debt, 7 is equity. Then above 5 lakh up to 10 lakh, above 10 lakh up to 20 lakh, above 20 lakh. Tax rate 30% is of no use because ICI has taken this to be post-tax cost of debt. This is, if you take it as pre-tax cost of debt, then you have to adjust the tax rate and make it as post-tax cost of debt. Cutoff rate is basically the discounting rate. If the requirement is 15 lakh, I'm not going to do 15 lakh, I'll do 26 lakh, which will need more calculation. And if a project will give a 13% return, under what condition should it be acceptable? We'll see that also in some time. 26 lakh is my requirement. Now, the given table can be understood in two ways. One is your income tax possible. What is under income taxes? We follow a slab rate system. What is slab rate is, if somebody's income is 20 lakh rupees, first 5 lakh you will have exemption. Then next is 5 lakh, there could be a different rate. Next to 5 lakh could be a different rate. That is one way. The other way is under income tax for capital gain, we have a flat rate of system where you directly, whether the income is 1 lakh, 5 lakh, 20 lakh, 30 lakh, you directly charge one rate. So here ICA has taken this to be a slab rate system. What is slab rate system is, in the 26 lakh project, first 5 lakh project you have to do 10 and 12. Next 5 lakh you have to do 12 and 13.5. Next 10 lakh you have to do 13 and 15, and balance you have to do 14 and 16, and finally get an average. Finally get a average. That is called slab rate system. What is flat rate system? Just directly use the single rate. Use the single rate for entire 26 lakh. So we are going to follow slab rate system to do this. Let's do hurdle rate or cost of capital. Cost of capital for project worth 26 lakh. Source cost weight product. Source cost weight product. Source cost weight and product. First 5 lakhs. First 5 lakhs. First 5 lakhs. Debt 3, equity 7. Debt 3 component, equity. Debt is 1 lakh 50, equity is 3 lakh 50 in the first 5 lakh. And cost of debt is given 10%, cost of equity 12%. Multiply and write the outer column. 10 and 12%. If you say 10 is pre-tax, then you have to adjust the tax rate there. ICA has taken it to be post-tax. First 5 lakh. Then the next slab is 6 to 10. Next to 5 lakh. Again, debt and equity 3 is to 7. Debt 3, equity 7, 150, 350, 12%, 13.5%. Forty-seven 250. This is next to 5 lakh of raising. This goes on, it doesn't end here. Then next to 10 lakh. Why next to 10 lakh is 10 to 20 lakh. 10 to 20 lakh. Again, debt 3 components, equity 7 component. 3 lakh, 7 lakh. 13%, 15%. 39,000 and 1 lakh 5,000. So we have done 5 plus 5 10, 10 plus 10 20, and balance 6 lakh. This approach is called slab rate system. $180, $420. The cost here is 14%, 16%. You'll have to put a total of weights and total of product, and automatically you'll get the answer. Tell me the total of the product column. Sorry, 3,58,000. Sum of product by sum of weights. Sum of product by sum of weights. Like this 15 lakh was also asked, which we are not doing. We have just done the 26 lakh part. 13.79%. Any doubts on this? Clear? Assuming you had done the other one also, which is 12.95, here I've done a weighted average originally for every slab and directly did first 5, next 5, next 10, balance 6, instead of giving the breakup of debt and equity. Final answer will remain same, 13.79%, whether you write it in detailed way or you write in simple way. Now question is saying 15 lakh, right, 15 lakh, right, 12.95, this we have not done, right, 15 lakh, 12.95, 26 lakh, 13.79, 15 lakh, 12.95, 26 lakh, 13.79. Now the part 2 is saying if a project will give a return of 13%, under what condition it is acceptable. What condition is 15 lakh? If the cost of the project is 15 lakh, 13% return is okay. But if the cost of the project is 26 lakh, 13% return is not okay, because for a 26 lakh project, I need the return to be 13.79%. So at what rate will we get 13% is the requirement. 13% question mark. 15 lakh, 12.95, 26 lakh, 13.79. So they said we will do interpolation technique and then get to the answer. What is interpolation technique is? Now write increase of project cost by 11 lakh. Increase of project cost by 11 lakh increases cost of capital by 0.84%. 13.79 minus 12.95 increases cost of capital by 0.84%. Project cost has increased by 11 lakh, cost of capital has increased by 0.84%. I want the cost of capital to increase only by 0.05. This is called interpolation technique. What is interpolation technique is, at 12.95 cost is 15 lakh, 12.96 it could be 15 lakh 10,000, 12.97 could be 15 lakh 20, 25, like this it will keep increasing. At some stage we will get exact 13%. At some stage we are going to get 13%. Next, we want the cost to increase from 12.95% to 13%. Increase of 0.05%. Cost to increase from 12.95 to 13%. Increase of 0.05%. 0.84% increase is equal to 11 lakh increase. Proportionate. 0.05% increase is equal to question mark. 11 lakh is 0.84. Do cross multiplication. 0.84 is equal to 11 lakh increase. 0.05 is equal to what increase? Calculation is 11 lakh into 0.05 divided by 0.84 into 0.05 divided by 0.84, cross multiplication. 11 lakh into 0.05 divided by 0.84. Hence at project cost of 11 lakh 65,476. At a project cost of 11,65,476, cost of capital will be 13%. I'll repeat again. 15 lakh gave us 12.95, 20, which we did not do. 26 lakh gave some 13.79. There was an increase of 0.84 when the project cost increased by 11 lakh rupee. I want 12.95 to become 13. 12.95 to become 13, which is just an increase of 0.05. So 0.84 increase is equal to 11 lakh. 0.05 increase is question mark, which is 65,000. This is an approximate answer. Interpolation always gives approximate. In the printed material, I have given the exact answer also, but this is approximate. I say as followed, approximate answer. Any doubts on this? With this, the discussion of the chapter gets over. High probability one question will come of around 8 to 10 marks from this chapter. Any doubts on this? Clear? Yeah. 15 lakh, sorry, 15 lakh, 15 lakh. 15 lakh. 1565,476. 15 is the base. So from 15, it increases by 65,476. So 1565,476. Now, in order to revise this, ideally you will have to go through only this, which is, now I'll quickly show this. Capital means long-term money, equity, debt and preference. There's an external equity, there's an internal equity. Cost means what company is paying every year divided by what company is getting today. Return means what investor is earning every year divided by what investor is giving today. Features of debt, there are three types of debt: redeemable, irredeemable, convertible. Face value 100 assume. Coupon rate refers to the interest rate. Issue price and redemption is at par if the problem is silent. Interest is equal to face value into coupon rate. Net proceeds, new issue happening today, issue price minus flotation cost. New issue not happening today, current market price. Logic that issue will happen today at current market price and what company can collect today. Irredeemable debt, interest after tax by net proceeds. Redeemable debt, approximation formula, interest after tax plus average other cost by average funds employed. Average other cost is divided by balance life, and IRR method or YTM method, which is the detailed approach. Then valuation of bond, irredeemable debt, value like a perpetuity, interest in rupees divided by investor yield or market yield. We have used this in 3-4 question. And redeemable debt, present value of future cash flows discounted at investor required rate of return. Cost of convertible debt, approximation method or IRR method. Redeemable value higher of the two. Redemption as debt, take at par if problem is silent. Convert into equity, expected share price on maturity into number of shares on conversion. Then cost of equity, dividend paying company, non-dividend paying company, realized yield approach, earnings based approach, and PE multiple. In case no other formula is possible, one formula for K is 1 divided by P multiple. 1 divided by P multiple. How to compute growth rate? Again, we have used it in many questions. Based on earning ability, based on past dividend history. Earning ability is ROE into retention ratio. Past dividend histories, take the future value and present value and then calculate it. Cost of retained earnings is same as cost of equity. Two exception. Flotation cost, P naught minus F is replaced with P naught in KE formula. Data on personal tax is given. KE into 1 minus personal tax percentage into 1 minus flotation cost percentage. Cost of preference, irredeemable, redeemable and IRR method. Preference dividend by net proceeds. Preference dividend plus average other cost by average funds employed. WACC, single cost for entire capital structure. Book value approach, market value approach. Compute cost of individual components of capital. Do weighted average. X interest and this concept is there in one of the MCQ in this material. So in the 120 question, initial MCQs, you will see this concept being there. See the concept and then solve it. Market value of equity, value of equity capital, retained earnings, no separate value, split the value. So concept 14, I did not do a problem. 14th concept, I have not done a question, but that is covered in the MCQs. Impact of raising new debt, weights change, hence WACC change. Cost of existing component of capital can also change. We saw a question where 50 lakh rupees was raised and that led to change in cost of equity. WMCC, cost of raising additional money, same under book value approach, market value approach. Identify from where the money is to be raised, compute cost of the various components and put it in the format. Maximum capex with retained earnings, the last to last question which we did. Identify available retained earnings. Maximum capex is equal to available retained earning divided by weight of equity. This is what this chapter was all about. In case you even revise it with the charts, solve the MCQs now. No need to do questions. Everything is done. I don't expect you to do any question beyond this. We have already done all the questions which were there. You want to revise, you revise it. But MCQs you'll have to do. MCQs which is there in this book as well as the concept book. Clear? Done. I move to the next chapter which is on capital structure. Chapter 4, 5 and 6 is our initial starting point. So chapter 4 is done, which is cost of capital. Chapter 5 is on capital structure. Now, what is the difference between the cost of capital and capital structure chapters? In capital structure chapter, we are going to focus on deciding what is the right capital structure for a company. Is it 100% equity, 50% equity, 50% debt, 25% equity, 30% debt, 60% preference? What combination should I follow is what the focus of this chapter is. Let's directly see questions. To question 1, page 29, question 1. GT Limited is willing to expand its business for which it requires an additional finance of 50 lakh. At present, capital structure is as under: 7 lakh equity shares of 10 each, 10% debenture, 12% term loan, retained earnings. At present, the EBIT is 54 lakh. Company after expansion expects ROI 2% greater than the present ROI. Income tax rate is 30%. Two options for getting additional finance: raise funds as term loan at 12%, raise funds by issuing 1 lakh equity shares at 20 per share, and balance by issuing 11% debenture at par. Find out the market price of the share if the P multiple is 10. Recommend the suitable option of raising funds with reason. So here I have to raise 50 lakh. Earlier chapter would have said you raise 50 lakh, calculate WACC. That's all. It would have just focused on calculating WACC. This chapter says, tell me from where should I raise debt, debt and equity, debt, equity and preference. That is what we are going to do. Now, here it's an existing company. Some question it could be a new company also. Today I'm earning 54 lakh rupees using this much of capital. What is the capital? The term capital means not equity capital. Capital means debt, equity and preference put together. So today in my business, the capital employed of my business is debt plus equity plus preference all put together. When I add a total, I'll get a number. A business today is earning 54 lakh. It is adding extra finance, adding extra capital in the balance sheet. When you add extra capital in the balance sheet, ideally you will earn more money. How much more money we are earning and what happens, we'll see. The question wants us to calculate market price and decide which is better. We normally follow 3 steps, right? Step 1. This step is of no use in this question, but okay. Working note 1, identification of alternatives. Identification of alternatives. It's given clearly in the question. Alternative 1. This 50 lakh will come in 2 ways. What is the first alternative? Raise term loan at the rate of 12%. This step is of no use in this question. That's why in the printed material I wouldn't have written this step. Alternative 2, equity capital of rupees 20 lakh, 1 lakh shares at the rate of 20 per share, and 11% debentures of 30 lakh. 20 lakh and 30 lakh. Working note 2, computation of interest and number of equity shares. We also need to do preference dividend, but in this question preference dividend is not there. Interest and number of equity shares. Particulars: alternative 1, alternative 2. Alternative 1 and alternative 2. Step by step will follow. Interest cost Below that, existing cost, existing interest, new interest, total interest. Existing, new and total. Existing, new and total. Today the company is paying already some interest expense, which is 10% debenture into 63 lakh and 12% term loan into 54 lakh. So today we are paying 6 lakh 30 plus 54 lakh into 12%. 6 lakh 30 plus 6 lakh 48. 10 lakh. This is already paid by the company. On top of this, I'll pay extra interest. In the option 1, we are raising 50 lakh into 12%. 50 lakh rupees into 12% term loan. And in the option 2, we are raising 11%. This will give me the overall interest expense. 18 lakh 78,000. 1878. Another one is 16. 16 lakh 8,000. The interest expense from the existing 1278 goes up by 6 lakh and 3 lakh 30. Number of equity shares. Existing shares, new shares, total shares. Existing is 7 lakh. I don't issue any new shares in alternative 1. Alternative 1, no new shares are issued. Alternative 2, we are issuing new shares. 1 lakh shares we are issuing. 7 and 8 lakh. Computation of price. They wanted us to calculate price. Again, particulars and 2 alternatives. We will do only alternative 1. You will not do alternative 2. It's just going to be copy paste. We'll focus only on alternative 1. Later on, if you want, you fill alternative 2 at home. The format is right: EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity shares, EPS, P multiple, MPS. EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity share, EPS, P multiple, MPS. It can even go beyond this. Beyond this is again you multiply with the number of shares, you'll get market value of equity, market value of debt, market value of preference. In this question, they have not asked us to go till firm level. When we do till firm level, you'll understand as we proceed. So here, EBIT is the starting point, which is the tricky part. EBIT, today the EBIT is 54 lakh, but the same 54 lakh will not continue because I'm doing some investment and all. Ideally, I have to earn more. Now come down below the table, new EBIT calculation. Below the table, new EBIT. ROI is equal to EBIT by capital employed. EBIT by capital employed. 54 lakh. ROI is EBIT by capital employed. 54 lakh by what is capital employed is equity plus debenture plus term loan plus reserves and surplus all put together. So equity today is 70 lakh. Debentures is 63 lakh. Term loan is 54 lakh. Retain earnings is 130 into 100. Give me a 2 decimal answer. 54 denominator I think is 317. So 54 by 317. 17 point. Clear? Now write again. ROI, are you right? New ROI is equal to new EBIT by new capital employed. New ROI is equal to new EBIT by new capital employed. New EBIT by new capital employed. New ROI is equal to new EBIT by new capital employed. Now in the question they have said ROI is going to improve. If nothing is given, I will have copied 17.03. It says ROI expects ROI 2% greater than the present ROI. 2% greater than the present ROI. So this side 19.03. New EBIT. Capital employed is 317 plus extra 50 lakh. Extra 50 lakh you are raising. 317 was already there. Extra 50 lakh we are raising. It could be in the form of debt, could be in the form of equity, could be in the form of term loan. All put together, it is 367. This will give you the new EBIT. 367 lakh into 19.03%. 69 lakh. Right, 69,84,010 here. We are not doing alternative 2. There also same number. 69,84,010 will come. Let's not do the alternative 2. Alternative 1 is sufficient. Beyond this, it's just calculator's job. Interest is there in your earlier working note. Tell me the interest of alternative 1. 1878, subtract 1878. 51,06010. What is the tax rate given? 30%. So apply 30% on this. 15 lakh 31,803. 35 74 207. No preference dividend. EAS 35 74 207. Number of equity shares in alternative 1 is 7 lakh. EPS 2 decimal should be fine. 5.1 12111. 35 74 207 divided by 7 lakh. 5.106. So 11. P multiple is given in the question. What's the P multiple? 10. Multiply, that's all. I will go ahead and select whichever gives me higher market price. I'll do both. Okay, the other one also we will do it, and whichever gives us higher market price, we go ahead and choose that. The important part is getting the EBIT number correctly. EBIT is 69,84,010. Balance was just a formality. We are going to go ahead with alternative 1 because it has better earnings per share as well as better market price per share. Clear? Any doubts on this? Go through question 2. Okay. Again, there are two alternatives. We are now going to note down the alternatives: 100% equity, 50% equity, 50% debt. We'll calculate the same thing: computation of interest and number of equity shares for the two alternative, and then go ahead and select whichever is beneficial. Let's do this. Computation of interest and number of equity shares for two alternatives. Interest and number of equity shares for two alternatives. Particulars: alternative 1, alternative 2. Existing interest, new interest, total interest, existing shares, new shares, and total shares. Interest and number of equity shares for two alternatives. Is there any indication anywhere in the question about any existing borrowing? No. 0, 0. Existing interest is 0 and 0. Existing interest is 0 and 0. The new interest expenses, how much money we are raising? 5 lakh rupees, in that 50% in the form of debt. 50% in the form of debt, and it has an interest of 12%. Cost of debt is 12%. New interest is 5 lakh into 50% into 12%. We get 30,000. 0 and 30,000. Existing shares are 25,000. New shares in option 1 is 5 lakh divided by some issue prices given at a premium of 10 per share, at a premium of 10. So face value is 10 rupees, premium 10 rupees, divide by 20. 25,000. 2 lakh 50,000 divided by 20. 12,500. 50,000 and 37,500. Clear? Now, this question is not like the previous question on EBIT side. EBIT side, what they are saying is the plant will give an EBIT of 2 lakh per annum. That is okay. This is the new plant. What is the existing EBIT? I don't know, because the new plant will give 2 lakh. Existing EBIT, I don't know. That also I have to calculate. How will I calculate existing EBIT? Is somewhere using this information. How will we do? You'll understand. But existing EBIT needs to be calculated. On top of it, 2 lakh. No ROI formula and all here. Existing and then new. Next, computation of NPS. Same table, the earlier format, but it will be particulars existing also you have to do. Particulars existing, alternative 1, alternative 2. Existing, alternative 1 and alternative 2. First I will do the existing one and then I do alternative 1 and 2. Existing, write the format: EBIT less interest, EBT less tax, tax at 40%, write the format. EAT, preference dividend, EAS, number of equity share, EPS, P multiple and MPS. First, we have to analyze the existing data and then we will do alternative 1. 2, you can do at home if you want. Existing, alternative 1. Okay. Existing, we are going to fill it in the reverse order. The question has said the market price is 24, market price is 24, P multiple is 8, reverse order you'll get earnings per share. The entire table will be filled in the reverse order. 24 8, EPS is 24 by 8, T 24 by 8, T. Number of equity share existing, how many? EAES 75,000, no preference dividend. EAT 75,000, EBT 75,000 divided by 1 minus tax rate. 75,000 divided by 1 minus tax rate. Tax is 50,000. Existing interest was not there. EBIT 125. Now from this 125 we will add whatever number is there and then complete it. That's a more of a simple calculation. 125 extra how much? 125 extra 2 lakh, 325. Okay, let's do both the alternative. It will not take much time. 325, 325, 325 and 325. Interest expense is written in your earlier working note. Beyond it's just a formality. How much is the interest expense? 0 and 30,000. 0 and 30,000. EBT 325, 295. Tax, tell me the tax amount. 1 lakh 30 and 80. 18. EAT is 2 lakh 295. 295, sorry, not 295. 195. Other one 1 lakh 77. No preference dividend. Number of shares are different. 50 and 37 500. EPS 3.9 and 4.72. Okay, 4.72. And question has said, listen, the P multiple of leveraged company. Leveraged company is the company which has taken borrowing. So if you take borrowing, P multiple is 7. If you don't take borrowing, P multiple will continue to be 8 times. P multiple will continue to be 8 times. But if you borrow, it will become 7 times. Borrowing will become 7. So P multiple here is, in this situation, it is 8. Here it is 7. And whichever gives higher price. 33.04. EPS is not my conclusion based on price because the P multiple are different. Sometimes EPS may give a different conclusion. MPS may give a different conclusion. We will go with MPS. We will go with MPS because MPS is superior to EPS. Any doubts on this? So earlier question we had done the calculation using the ROI formula. This question existing EBIT plus the new EBIT. Existing EBIT plus the new EBIT. Any doubts on this? Clear? Can we proceed? Go through question 3. Okay, similar to the earlier first question, but with little bit more adjustments here. I want to raise 30 lakh for modernization of the plant. All that is fine. Company expects a rate of return on funds employed. Rate of return on funds employed is ROI to be improved by 3% because of the modernization. Debt equity ratio exceeds 45%. Then the price earning ratio will go down by 15%. So some changes on the P multiple level also they're talking about. If the company is to follow policy of maximizing the market value of equity share means single share, so market price per share, which option would it choose? So somewhere around this calculation we have to do. We know the two alternative: raise the entire funds by 13% long term loan, partly by equity share and partly by debenture, with certain adjustments here and there. Working note 1: computation of interest and number of equity shares. Interest and number of equity shares. Again, preference dividend is not there. Particulars and two alternatives. Interest cost, existing cost, new cost, total cost, number of equity shares, existing shares, new shares, total shares. Now, existing cost, let's be little clear. It says 2 lakh 70, 3 lakh 60, but the problem is this were issued on 1/8/2018, which means even if I don't issue any debenture extra, this amount will go up because this was not a full year interest. 1/8/2018 would mean this is not the full year interest expense. It was issued on 1/8/2018, which means this is an expense only for a period of 8 months. I will need 12-month expense for the next year. So the existing interest itself will undergo change. So existing is 2 lakh 70 plus 3 lakh 60 into 12 by 8 into 12 by 8. The existing expense itself will go up 8 lakh 10,000. On top of it, whatever extra we raise. In the first scenario, entire funds 30 lakh into 13%. Entire funds is term loan. And in the second scenario, 75,000 at 20 per share, which is 15 lakh rupees. Another 15 lakh is debenture. 1 lakh 65,000. Total cost is, tell me the total. 12 lakhs and same way existing equity shares are 6 lakh 30 given in the table. New shares are 75,000. 630 plus 75. 630 plus 75. There is an adjustment on the existing interest cost itself in this question, which is a little bit of a unique adjustment. Existing interest cost itself is adjusted in this question. Any doubts on this? Format remains the same. Analysis is going to remain the same. Working note 2, computation of MPS. Again, I will need an existing data for some purpose. Computation of MPS. Existing alternative 1, alternative 2. Same format, alternative 1, alternative 2. Existing alternative 1, alternative 2. Let's fill the existing one. There is some purpose of doing the existing one. Let's copy whatever data is given in the question. It's there, it's just copy pasting 2880, just copy pasting from the question. 630, tax is at 30%. There's a reason for this, you'll understand later. 2250, 675, 1575, EPS, P multiple and MPS. Twenty-four divided by 2.5. 9.60. I've done this just to get this 9.60 number. Reason is, it says in the rework scenario, P multiple can go down by 15% in case the debt equity ratio changes. And in case it does not go above that, it will continue at 9.6. So I need that existing P multiple. Last question, the existing P multiple was given as 8 and new P multiple for a levered was 7. Everything was given. Here they have said the P multiple can go down by 15%. Now I have to do the EBIT calculation. For EBIT calculation, we'll have to use the ROI formula first. Get the ROI number, increase the ROI, increase the capital employed, and get the new EBIT. Now come down. ROI is equal to EBIT by capital employed. EBIT number today is 2880, 2880, and capital employed number today, listen, 2,70,000 divided by 12% is the loan today. 2,70,000 divided by 12% is the long term loan today. 3,60,000 into 12 by 8, whatever you did, divided by 10%. Divided by 10% is the debentures today. Shares is 6,30,000, face value assuming 10 rupees, and reserves and surplus 60,50,000. Reserves and surplus is 60,50,000. So 2,70,000. It's very good question. Divided by 12%. 6,30,000 divided by 10%. 6,30,000 into 10, and finally 60,50,000. All put together is the capital employed denominator. Let me know what is the capital employed you get. 2 crore. Get the ROI number. Again, we will use the same formula now. 14.4% is the ROI today. 14.4% is the ROI today. First question also we had to do this, but there the numbers were given directly. Here little bit more complication. 14.4%. Then new ROI is equal to new EBIT by new capital employed. New ROI is equal to new EBIT by new capital employed. ROI, is there a change? Improved by 3%. So 14.4 will become new EBIT. Capital employed is 2 crore 30 lakh. 2 crore 30 lakh. Capital employed from 2 crore is increasing to 2 crore 30 lakh. How much is the final number? 40. Right here, come down. Come to the main working note. 40 lakh 2000. 40 lakh 2000. Balance is just a formality. P multiple, some discussion will be needed. Interest, all this we have already calculated. Copy paste the numbers. 12 lakh 975. Beyond this, it's just a formality. 2802. 30 lakh 27,000. 840 600. 1961 400. No preference dividend. 1961 400. 6 lakh 30,000. Give me a 4 decimal EPS. 3.11. The other one is other side is, tell me the numbers here. 21, 19, 18 900, 7 lakh 5,000. 00. Okay, let's keep it 4 decimal just to avoid the, because the numbers are very close. 3.1133. If I round off, I may get 3.1133, 3.0055. Now the next is P multiple, but P multiple depends on a ratio called debt divided by debt plus equity. Depending on that ratio only, I can calculate this. And if it exceeds 45%, then the P multiple will go down by 15%. If it does not exceed 45%, P multiple will continue to be whatever we had calculated in the existing situation. So now come down, debt divided by debt plus equity. Technically, it's called debt ratio. In alternative 1, this will be there 27 lakh by 2 lakh 70 by 12%. This will be there, and on top of it, another extra 30 lakh is coming in the form of debt. Capital employed is debt plus equity is 2 crore 30 lakh. Debt plus equity is 2 crore 30 lakh. Debt value is 2 lakh 70 by 12%, 6 lakh 30 by 10%, another 30 lakh rupees, another 30 lakh rupees, and in alternative to another 15 lakh rupees. So what is 2 lakh 70 by 12%? How much? 2 lakh 70 by 12%. So right, 22 lakh 50 plus 63 lakh 63 na 54, second one. Then is it 630 by, okay, this was not, take it, leave it, plus 54 lakh plus 54 lakh plus 30 lakh whole divided by 2 crore 30 lakh into 100 to express in percentage. 46 point. So it breaches that limit of 45%. It has breached the limit of 45%. That's at a limit saying 45% is this ratio. If it exceeds 45%, you are borrowing more. If you borrow more, risk is increasing. When risk is increasing, they want to reduce the P multiple as per the question. Other situation, mostly it will not breach 2250 plus 54 lakh. Borrowing is only 15 lakh in the other situation. $39 point. So first situation it is breaching, second situation it is not breaching. First situation 45% is the limit we had set in. If you exceed that 45% limit, P multiple will go down by some 15%. If you don't exceed the limit, P multiple will not go down. Any doubts on this? Here, P multiple is 9.6 minus 15%. Other side 9.6 as it is. 9.6 minus 15%. 8 point and then multiply and get the price. Now 2 decimal is fine after you multiply. 25.40, 28 point. So the second alternative has lower EPS. It has lower EPS, but still we will go ahead with alternative 2 because it has better market price per share. It has better. The objective was to maximize market price per share. Any doubts on this? Clear? The only extra add-on adjustment here was that existing interest itself we had to adjust it and then do the calculation. Okay, we are now going to solve this question. Just give me a minute. Okay, you can manage this. It's a almost similar question. Almost a similar question. Something which you can manage. Just give me a minute. Almost a similar question. You can manage it. Only thing is here the definition of debt ratio is little different. Okay, they have given definition. Follow that and then accordingly do the question. Here debt ratio means debt by equity. There it was debt divided by debt plus equity. The definition is different here. And in the problem, they have not talked about what will happen to ROI. So we have assumed the same ROI to continue, but still EBIT can improve. Same ROI continues, but still EBIT can improve. How can EBIT improve? Because capital employed will go up. The capital employed will go up, so that will lead to improvement in the EBIT number. Go through question 5. Okay, more or less a simple question, but I want to discuss the next concept, which is called indifference point and financial break-even point. And in fact, in the latest, I think the earlier exam, they had asked a question from this area only on the indifference point. The question came from this area. A company needs 31 lakh 25,000 for construction of a new plant. Following three plans are feasible. One, 100% equity. Second one has equity and debentures. Third one has equity and preference. If the EBIT number is this, what will be the EPS? We'll see this later. Which alternative would you recommend? A and B we'll see later. First, we'll do financial break-even point and indifference point. What is financial break-even point? Is the level of EBIT at which EPS will be equal to 0. Financial break-even. Break-even means no profit, no loss. So, break-even point means the level of EBIT at which earnings per share will be equal to 0. Working note 1, computation of interest, like the previous one, interest, preference dividend and number of equity shares. Number of equity shares, particulars and three alternatives. Particulars and three alternatives. interest cost, preference dividend, number of equity shares. There is no existing information here. I'm not writing existing, new, and total. Directly only one calculation. Interest cost, preference dividend, number of equity shares. In the first alternative, no interest, no dividend, only shares 3,12,500. 3,12,500 shares. Alternative 1, 0, 0, and 312, 500. Alternative 2, you're going to issue debentures, 15,625 debentures into 100 into 8%. 15,625 into 100 into 8%. Tell me what is the interest expense? No preference dividend, and number of shares is 156, 250. I think same preference dividend, same 8% they have given. 156, 250. Financial break-even point is equal to interest plus preference dividend divided by 1 minus tax rate. Preference dividend divided by 1 minus tax rate. The definition is level of EBIT at which EPS is 0. Alternative 1, 0 plus 0. Which technically means if EBIT is 0, EPS will be 0. If EBIT is 0, EPS will be 0. It will not become negative because there is no interest expense, no preference dividend. Alternative 2, we have interest expense 1,25,000. 125 plus 0, 125. So if you earn 1,25,000, then you will have EBIT 125, interest 125, EBT 0, everything will become 0 beyond that. And alternative 3, because preference dividend is not tax deductible, you have to earn more than 125. What is the tax rate in the question? 1 minus 0.4. You have to earn more than 1,25,000 so that you can pay tax, get 1,25,000 and then pay the dividend. How much? 2 lakh? 208,333. This much I have to earn to get 0 EPS. To get 0 EPS, I have to earn 208,333. This is part 3 of the question, which is financial break-even point. Any doubts on this? Next, computation of indifference point. Use the same format, EBIT till EPS, right? EBIT till EPS. From EBIT till EPS. Computation of indifference point. Particulars and 3 alternatives. Now, for calculating indifference point, right, EBIT as X. That's how we calculate indifference point. EBIT is X. EBIT is X. Interest expenses 0, negative 125, 0, x minus 125 and again x. Tax rate is 0.4x, 0.4x minus 50,000 and 0.4x. 0.4x, 0.4x minus 50,000, 0.4x, 0.6x, 0.6x minus 75,000, 0.6x, you have to assume it as x and do the calculation. Clear? Done. Now, what is indifference point is the level of EBIT at which two plans will give same earnings per share. So, indifference point is always between two alternative. It can't be among three. So, we will do between 1 and 2 one answer, 1 and 3 another answer, 2 and 3 another answer. So, below the table, indifference point between 1 and 2 equate 0.6x by 312,500 is equal to 0.6x minus 75,000 by 156 250 one time, two times, one time cancellation, 2 and 1, and then simplify and get the answer. 0.6x 1.2x minus 1,50,000. You will get answer here. 2 2 and 1 time, 312,500, 156 250, 2 times and 1 time. X equal to 2,50,000. X equal to 2,50,000. Clear? Similarly, I'll have to equate then. So this is the indifference point between 1 and 2. Plan 1 and plan 2. Indifference point is 2,50,000. Then 1 and 3. 1 and 3. 0.66 by T12,500. 0.6x minus 1,25,000. Again 2 times 1 time. And you'll get answer to x. 4 lakh 667. 416,667. Any doubts on this? Clear? Then 2 and 3, here you will get stuck. 2 and 3, 0.6x minus 75,000, 156 250, 0.6x minus 125, 156 250, everything got cancelled, which means there is no indifference point between 2 and 3, and one plan dominates the another plan. It means one plan is dominating the another plan between 2 and 3. See, what is indifference point is, at indifference point both are good. Above indifference point one plan will be good, below indifference point other plan will be good. But if you are solving and you are not getting an answer for x, it means one plan is always better than the other plan. One plan is always better than the other plan. Any doubts till this? Now write plan 2 in bracket, plan with lower financial BEP, plan with lower financial BEP dominates plan 3, plan with higher financial BP. Between 2 and 3, 2 is going to dominate 3. How do I find? Whichever has lower BP between 2 and 3. Between 2 and 3, whichever has lower financial break-even point. Financial break-even point we computed some time back. Whichever has lower financial break-even point, that plan dominates the other plan. That plan dominates the other plan. Any doubts on this? So plan 2 is going to dominate plan 3. Plan 2 is going to dominate plan 3 because plan 2 has a lower financial BP. Plan 3 has a higher financial BP. So in this question, part 2 is saying which alternative will you recommend? I have only 2 alternatives, 3 I don't have. The third alternative is removed from the question. Only 2 alternatives we have. Either plan 1 or plan 2. At 2,50,000 both are equal. Above 2,50,000 one plan will be good. Below 2,50,000 other plan will be good. How do I identify that? They have given 5 numbers. Now doing 5 numbers EPS calculation is a time consuming task. So what we are going to do is, in place of this x, we are not going to do this now. In place of x, you will substitute 62,500, get 1 EPS. Then substitute 1,25,000, get the second EPS. Substitute 2,50,000, get the third EPS. Substitute 3 because x is EBIT. X is EBIT. So you keep substituting different EBIT given in the question, and you will keep getting different earnings per share. So something like this. I'll substitute here. I get so many EPS. At 2,50,000 both are equal. Above 2,50,000 plan 1 is better, and above 2,50,000, that is here plan 1 is better and here plan 2 is better. This is how we will give a final conclusion. Plan 3 is of no use. Plan 2 is always better than plan 3. Plan 2 is always better than plan 3 because when we solve we did not get an answer for x. If you do not get an answer for x, it means one plan is dominating another plan. At indifference point both are going to be equal. Above indifference point, that is above 2,50,000 and below 2,50,000, either of the plans will be better. Clear? Any doubts on this? How do I find? You can substitute any number and check. 2 lakh number you substitute and find whether plan 1 is better or plan 2 is better, and substitute 4 lakh and check whether plan 1 is better or plan. Here they have given 5 numbers, so I have to substitute all the 5 numbers: 62,500, 125, 250, 375 and 625, and at any of the levels alternative 2 is better than alternative 3. Clear? Any doubts on this? So to find out indifference point, assume EBIT as x, get EPS in terms of x, and then keep solving 1 and 2, 1 and 3, 2 and 3. If there is a plan for 1 and 4, between 2 plans only you can calculate this. Any doubts on this? Clear? Okay. I'll take a 10-minute break and then proceed to the balance areas. Okay, let's continue now. Let's come to question 6. A new project is under consideration in Zip Limited, which requires an investment of 4.5 crores. Interest on term loan is 12%. Corporate tax rate is 50%. Debt equity ratio insisted by the financing agencies 2:1. Calculate the indifference point of the project. So they ask for indifference point. Any question on indifference point, we always need 2 alternatives. Here, one direct alternative is given, one hidden alternative is given. What is direct alternative is, I need 4.5 crore. 2:1 is the debt equity mix. So debt is 2 times, equity 1 time. That is first alternative. Second alternative is 100% equity because there is no information available. The other alternative is 100% equity alternative. So let's do question 6. Working note 1. Identification of alternatives. Identification of alternatives. Alternative 1, raise 3 crores as debt and 1.5 crores as equity. 3 crores as debt, 1.5 crores as equity. Alternative 2, raise entire 4.5 crores as equity. Entire 4.5 crores as equity. So these are the two alternatives we have: 3 crore debt, 1.5 crore equity, 2:1, and entire amount is equity. Working note 2, computation of interest preference, not preference, interest and number of equity share. Interest and number of equity shares. Interest and number of equity shares. Interest cost is 3 crore of debt. What is the rate of interest given? 3 crore into 12%. Into 12%. 36 lakh. They have not given any issue price. I'm assuming it to be 10 rupees face value. Any price you can take, doesn't really matter. Any price you take, 1.5 crore divide by 10, 15 lakh, 4.5 crore by 10, 45 lakhs. 15 lakhs and 45 lakhs. Working note 3, computation of indifference point. Indifference point. We'll take EBIT as X and get EPS in terms of X. Computation of indifference point. EBIT less interest, EBT. What's the tax rate given? Tax at 50%. EAT less preference dividend, EAES, number of equity shares and EPS. The interest expense in alternative 1 is 36 lakh. Second alternative 0. You do it and then please equate. Equate the two EPS, you'll get the indifference point. Beyond this is just a formality. You complete it and then equate the two EPS. 54 lakh rupees is the indifference point. At 54 lakh, both alternative will give same earnings per share. Above 54, one would be better. Below 54, another one would be better. Clear? Any doubts on this? Can you proceed? Okay. So with this, the two major discussion area gets over. One is on indifference point. Second is on financial break-even point. Next comes something called as capital structure theories. These theories have different conclusion. The conclusion I'll explain as I do a problem. And there'll be two types of question. One with income tax, one without income tax. With income tax, slightly different approach. Without income tax, slightly different approach. Let's directly get into question. Question 7. X Limited raised 10 lakh of debt, 10 lakh of equity. Cost of debt, cost of equity is 8 and 14%. Compute overall cost of capital, value of the firm using net income approach. Data as in A above. Rework the overall cost and value of the firm if the interest amount are 88, 96, 104, 112 and 120. Now in this question, when I read it initially, I do not find income tax rate in the question. If you do not have income tax, the format is slightly different. And if you have income tax, the format becomes slightly different. Let's start. Valuation of firm. Valuation of firm and cost of capital computation. Particulars and 6 columns. There is an original situation and 5 rework situations are there. Particulars, original, B1, B2, B3, B4 and B5. We'll do only maybe 1 or 2 rework situation. Balance will not do it. Format is EBIT less interest, EBT, leave a line. No taxes and all. EBIT less interest, EBT, leave a line. Cost of debt, cost of equity, cost of capital. Again, leave a line. Value of debt, value of equity, value of firm. This is a master format which will be used in next 5-6 questions. EBIT less interest, EBT, leave a line, cost of debt, cost of equity, cost of capital, leave a line, value of debt, value of equity, value of firm. Below this, write the formulae. Any of this can be used in the question. Cost of debt is equal to interest by value of debt. Nothing but interest by net proceeds. Interest by net proceeds. Cost of equities, EBT by value of equity. And cost of capital, you write and then I'll explain. Cost of capital, EBIT by value of firm. EBIT by value of firm. Cost of debt, interest by value of debt. Cost of equity, EBT by value of equity. Cost of capital, EBIT by value of firm. EBIT by value of firm. Now listen. Cost of debt is same formula. Interest after tax divided by, cost of debt is nothing but interest after tax divided by net proceeds. Cost of equity is, what do equity guys get is EBT, no tax and all. EBT is their reward. Cost of capital is both put together get EBIT divided by value of firm. Now these are not 3 formulae, they are 9 different formulae. How 9 different formulas? Some question I'll say value of debt is equal to interest by cost of debt. Some question I'll say Interest is equal to cost of debt into value of debt. The first formula can become three different formula. It's equal to A is equal to B by C. It can become A into C is equal to B, or A by B is equal to C. C is equal to B by A. You can keep interchanging the formula and then write it. Similarly, cost of equity is EBT by value of equity. Some question I may say value of equity is equal to EBT by cost of equity. Some question I may say EBT is equal to cost of equity into value of equity, and same goes with cost of capital formula. They are not three formulae, they are 9 different formulae. Let's capture whatever data is available, original situation first, and then we'll come to the rework. Originally they have said 10 lakh debt, right? 10 lakh is debt, 10 lakh equity, put together firm is 20 lakh. 10 lakh debt, 10 lakh equity, put together 20 lakh. Cost of debt is 8%, cost of equity 14%. Now please calculate interest. Calculate the interest and tell me the amount. 80,000, 10 lakh into 8%. Calculate EBT using that formula. EBT is equal to cost of equity into value of equity. 10 lakh into 14%. EBIT reverse working. 2 lakh. Now from the below, use the cost of capital formula. Use the cost of capital formula. From the below, use the cost of capital formula. 220 by, clear? Any doubts on this? Now in the rework, they have said multiple situation. I'll just take that 88,000. Take interest as 88,000. Interest is 88,000. Now the rework situation depends on the theory. Original situation has no linkage to the theory. In the rework situation, depending on the theory, this is what the theory says: net income approach, net operating income approach, traditional approach, approach without taxes. So multiple theories are there. The main point is on KE. KD leave it, doesn't matter. KE. Cost of equity will remain constant under net income approach. Under net income approach, cost of equity will remain constant. What is cost of equity? Is the risk of the equity guy. Whether you borrow more, borrow less, cost of equity will be whatever you originally saw. That is called net income approach. NOI and approach said, NOI and approach said, no, this will not work out. KE will undergo change. Increase with the increase in debt. KE will undergo change. Then what will remain constant is KO. That's all. This is the main theory. The two main theories is net income theory, net operating income theory. Other theories I'll explain as we proceed. Net income and net operating income are the two main theories. Is same as net operating income. And net operating income is totally 4 theories are there. Net income, traditional, net operating income, and approach. So in this question, they are saying rework under somewhere the theory name is given, net income approach. Same question I'm going to do here. Let's call it as net income. Maybe you change the heading. This is net operating income. Two questions we are going to do. Net income and net operating income. Other rework I'm not doing it. Net income and net operating income. Right, minus 88,000 again. Minus 88. If nothing is given, same EBIT continues. Same EBIT continues. Same cost of debt continues. Same cost of debt continues. Get the value of debt now. Value of debt will be different. Same 8%. Value of debt will be higher now. We have borrowed more. We have ended up borrowing more. 88,000 divided by 8%. This theory name and all does not really matter. Now comes the main impact of theory. Net income approach means 14%, you can write in brackets same KE. KE will remain same. 14% same KE. 14% same KE. Under NOI approach, 11% same KO. NOI approach, NOI has said cost of capital will remain same. He has given logic and all. I'm not getting into the full theory part. Net income approach said same cost of equity will continue. Net operating income or approach said same cost of capital will continue. Balance remains same. Like what I had explained earlier, we will do. Now let's go back here. 220 minus 88, 1 lakh 32. Value of equity is 132 divided by 14%. 132 divided by 14%. 42 put together 20, 42, 857. Cost of capital balancing figure. Cost of capital is EBIT by value of firm. EBIT divided by value of firm. 2 lakh 20 divided by 20, 42, 857. 10.7. This is net income approach. Same question. Next side we have done net operating income approach. Theory significance is only for a rework scenario. Net income approach has said same cost of equity will continue. Same cost of equity will continue. You can do 88,000, 9 to 6, so many rework situation. Same KE we will copy paste. Here same KO is copy pasted. Now in this case, EBT same 132. EBT same 132. But I cannot calculate value of equity now because value of equity is EBT by cost of equity. I don't know the cost of equity. I'll calculate value of firm. 2 lakh 20 divided by 11%. And equity is balancing figure. And cost of equity is balancing figure. 1 lakh 32 divided by 9 lakh. Understand the difference, okay? 1 lakh 32 divided by 9 lakh. How much you get? 6. Yep. So net income approach says same cost of equity is copy pasted. According to net income approach, they say that risk of equity shareholder will not change. What net operating income NO? NO means no change in value of firm. Net operating income NO. No change in this. How you'll remember? No change in value of firm. Value of firm will not change. Net operating income approach. No change in value of firm. Any rework situation you do, no change in value of firm. NOI and MM is same. NOI and MM is same. This is without taxes. With the tax, little bit of changes will come. Any doubts on this? Net income approach, same cost of equity. Net operating income approach, same cost of capital. EBIT, copy paste if problem is silent. Cost of debt, copy paste if problem is silent. Clear? Any doubts on this? Done? I think. Sorry, live online guys. I think net got disconnected in between. I'll explain again for the live online guys. Net income approaches same cost of equity copy pasted. Net operating income approaches same cost of capital is copy pasted. Clear? Any doubts on this? I'm not doing it. That is the net operating income approach, and 7 was net income approach. We have done together in single question. Go through 9. they have given some two companies, they are identical companies, some debt equity mix, all that is given. If you own 2% stock of Alpha, what is your return if the company has net operating income? Net operating income does not mean NOI theory and all. Net operating income or operating income means EBIT. The other name for EBIT is operating income or net operating income. Net income means PAT. Net income means profit after tax, and net operating income means EBIT. So they have given net operating income 360. Overall capital, what is the implied rate of return on equity? What is implied rate of return on equity? Is cost of equity. For a shareholder, it is called return on equity. For us, it's called cost of equity. Is there a tax rate in this question? No. Clear. If you have space here itself, I will do this because this format we are going to use. If you do not have space, then write the format again. Alpha, beta. If you have space, write it in the side. If you do not have space, then write the format again. A bit less interest, EBT. Okay, write the format itself again. Write the format. A bit less interest, EBT, cost of debt, cost of equity, cost of capital, value of debt, value of equity, and value of firm. Alpha and beta. This is without tax format. Okay, let's look at the information. It says 50% debt, 50% equity, 20% debt, 80% equity. Borrowing rate for both the companies 8%. Right, cost of debt 8%. Borrowing rate for both the companies is 8%. If you own 2% stock of Alpha, what is your return if the company has net operating income of 3 lakh 60? EBIT 3 lakh 60. EBIT 3 lakh 60. And it says overall capitalization rate. What is overall capitalization rate? Is KO. Overall capitalization rate is KO. 18%. KO is 18%. Now what can we calculate with this? Value of firm 3 lakh 60 divided by 18%. In this, debt is some component, equity is some component given in the question. Company Alpha debt component is how much? 50-50, so 10 lakh. Format will give you the answer automatically, 10 lakh and 10 lakh. Value of debt 10 lakh, value of equity 10 lakhs. Interest, let's calculate now. $80,000. EBT and cost of equity is the implied rate of return on equity. Cost of equity is nothing but implied rate of return on equity. What is the formula for cost of equity? EBT, value of equity. From that formula, you will keep using it. 28%. This is for company Alpha. 28% is the cost of equity. Beta has same net operating income as Alpha. Same net operating income. What is its implied rate of return? Why is it lower than that of Alpha? Now, copy paste 360. Now, they have not told what is the cost of capital of beta, and cost of equity is also not given. Depends again on the theory. Theory name is not given here. It depends on the theory. What does the theory says? If you are following net income theory, two companies, identical companies will have same cost of equity. Two identical companies, there it was a rework. Here it is two identical companies, same cost of equity. And if it is net operating income, same KO. Here they have not given the theory name. Obviously, I cannot write the same KE because question is asking what is its implied rate and why is it lower than that of Alpha. They are asking me why is it lower than that of Alpha. If it's lower than that of Alpha, obviously I cannot copy paste. So I'm copy pasting KO. I'm copy pasting KO, same KO. Either the same KE or same KO depending on the theory. Same KO is copy pasted. We get same 20 lakh. Breakup of 20 lakh is different here now. 4 lakh debt, 16 lakh equity, and using that interest is 4 lakh into 8%. EBT and cost of equity will be different now. 20.5. Now, reason for this being low here is risk is on the lower side. How risk is lower? Low borrowing, low risk. Company alpha has more borrowing, technically more risk, because when borrowing is on the higher side, first you have to pay interest and then you have to pay the equity guy. So high borrowing, high risk. Here low borrowing, automatically the risk is on the lower side. That is why the return is also on the lower side. Any doubts on this? Let's come to this. Go through the question. Okay, the question is talking about applying model with the taxes. So we have to do with the taxes. The format will undergo a little bit of change. Let's write the format first. Almost the same thing, but little bit of changes is there. A bit less interest, EBT less tax you have to write. EBT less tax, EAT, then leave a line cost of debt, cost of equity, cost of capital. All that is same. A bit less interest, EBT less tax, EAT, cost of debt, cost of equity, cost of capital, value of debt, value of equity, and value of firm. And below the table, less tax you have to bring in between. Below the table, the changes interest in the formula into 1 minus T, 1 minus tax rate, EBT into 1 minus tax rate, bit into 1 minus tax rate. Write the formula. Formula will also undergo change. Again, 9 different formula will come from this. Cost of debt interest into 1 minus tax rate. Cost of equity and cost of capital. Interest into 1 minus tax rate, EBT into 1 minus tax rate, EBIT into 1 minus tax rate. Clear? Let's go back up. Right? Before restructuring, after restructuring, before restructuring and after restructuring. 3 new formulae into 1 minus tax rate everywhere. Now listen, it says it's an all equity finance company before restructuring, right? Unlevered. Some differences will come because of this, and after restructuring is called levered. Unlevered means without borrowing, levered means with borrowing. Unlevered and levered. Let's first close the unlevered part. What happens in levered? What is the change? You'll understand. RES is an all equity finance company with a market value of 25 lakh. Right? Value of firm 25 lakh. Value of equity 25 lakh. Value of debt 0. 25, 25 and 0. Value of firm 25 lakhs. Value of equity 25 lakhs. Value of debt is 0. Cost of equity 21%. Cost of capital 21%. Cost of debt not applicable. Borrowing is not there. Please use the formula of cost of equity and tell me the EBT number. Use the formula of cost of equity. 21% is equal to EBT into 1 minus tax rate by value of equity. Use the formula of cost of equity and get the EBT number. 7,50,000. 21% is equal to EBT into 0.7 by 25 lakh. EBT 7,50,000. EBT 7,50,000. Any doubts on this? So right, EBIT 750. Interest is anyway not there. So EBT all are 750 only. Tax rate. Now NOI theory and MM theory said the two companies are, if you are without borrowing, with borrowing, 100% equity, 50% equity, 50% debt, 60% equity, any combination you do, value will remain same. This is what they said, and any rework scenario, same value will continue. NO, no change in value of firm. But when taxes came in, they said tax has certain tax benefit. Whenever you borrow money, there is a tax benefit along with that. Under this approach, now right below, value of levered firm is equal to value of unlevered firm plus amount of debt into tax rate. Value of levered firm is equal to 25 lakh unlevered firm. See, the question says earlier I'm an unlevered firm and suddenly I become a levered firm. How do I become a levered firm? By doing something called as buyback of equity shares and raising perpetual debt of 5 lakh. So normally they'll give two different companies. Here same company. Originally it is an unlevered company, then it becomes a levered company. How does it become levered? By doing the buyback of the equity share with a borrowing. Plus 5 lakh is the borrowing into tax rate is 30%. This is the value of levered firm. Unlevered plus amount of debt into tax rate. How much you get? 2650. So value of firm is 2650. Value of firm is 2650. Unlevered plus amount of debt into tax rate. Debt is 5 lakh, equity balancing figure. Equity balancing figure. Ideally, equity should become 25 lakh, 20 lakh, but because of certain benefits, the value is going up. 2150. 5 lakh buyback we have done. Same EBIT 750. Interest is 5 lakh into 15%. Cost of debt is interest into 1 minus tax rate. Cost of equity, cost of capital, apply the formula from the given, which is EBT into 1 minus tax rate, EBIT into 1 minus tax rate. You'll have to apply that formula which I have given. 6,75,000 into 0.7 divide by 2150. 675 into 0.7 divided by 2150. EBT into 1 minus tax rate by value of equity. What is the cost of equity you got? Next one is 7,50,000 into 0.7 by 2650. Formula I've already given one master formula, you remember, and then you keep interchanging the formulae. 7,50,000 into 0.7 by 2650. How much? 19.81. Because of the tax benefit, WACC has gone down. Cost of capital is nothing but WACC. The question has asked for three things: market value 2650, cost of equity, and WACC. WACC is cost of capital. So cost of capital has gone down from 21 to 19.81 because of the tax benefit. If tax was not there, the two scenarios, same KO will continue. Approach and NOI approach is same. Approach and NOI approach is same. Let's come to this. Question 11. Any doubts on the earlier one? Company XYZ is unlevered, cost of equity 20%, total market value 10 crore. Company ABC is identical except that it uses debt finance in its capital structure with a market value of 4 crore and a cost of 10%. Find the market value of equity, WACC, and cost of equity if the tax advantage of debt is 25%. To put it simply, tax rate is 25%. Tax rate is 25%. Write the format with taxes. Tax rate is 25%. Write the format, and they have given two companies now. Company XYZ, company ABC. One is unlevered, other one is levered. Unlevered and levered. Now I'll explain the rule again. First we will do unlevered company full table. Then we'll do levered company as unlevered plus amount of debt into tax rate. Now coming to company XYZ, they have said company XYZ is unlevered, cost of equity 20%. Cost of equity 20%, cost of capital 20%, cost of debt not applicable. 20 not applicable. Debt is not there. Value of debt is 0. Value of equity and overall value is 10 crore. 10 crore. Please use the cost of equity formula and tell me the EBT number. 25% is the tax rate. 25% tax rate. Use the formula of cost of equity. K is equal to EBT by value of equity into 1 minus tax rate. Or you can do KO also and get EBIT number also. Anything you do, that's fine. Let me know the EBIT number once you're done. Two crore 66 lakh 66,667. Same EBIT, interest is not there, tax is 66, 66, 667, and EAT is 2 crore. Any doubts on this? Always do the unlevered first, complete the table fully. Next, below the table, value of levered firm is equal to value of unlevered firm. Unlevered means without borrowing, plus amount of debt into tax rate. Unlevered firm plus amount of debt into tax rate. Crore plus 10 crore plus how much is the amount of debt? 4 crore. Tax rate is 25%. 11 crore. The table will automatically guide you to the answer. You be very clear on the formulae and the format. Table will automatically guide you to the answer. Value of firm is 11 crores now. ₹11 crores. Value of debt is 4 crore. Value of equity balancing figure 7 crore. 4 crore and 7 crore. EBIT same 2 crore 66, 66, 667. What the rate of interest? 40 lakh. You get 1 crore. Cost of equity is 24.29%. Everything will come from the table itself, 24.29. You just need to clearly write it. $24.29. Cost of capital is EBIT 2 crore 66 667 into 0.75 divided by 11 crore. What's the number you get? 18 point clear. 18.18%. There's a dip in the cost of capital and there is an increase in cost of equity and overall value is going up. Any doubts on this? Okay, let's come to 12. The following data relate to two companies belonging to the same risk class. Net operating income, 12% debt, equity capitalization rate. Determine market value, equity capitalization rate, WACC, assuming no taxes as per MM approach. As per MM approach. So the theory name matters when you have to do two companies comparison. They have said MM approach and no income tax. Then the same MM approach with income tax of 40%. If no income tax is there, both the company will have same value. Both the company will have same value. Anyway, we'll do it in the format. Right, open the format. Without tax format first. Without tax format. Particulars. They've given two companies. They've not given any name and all. I'll call it as company one and company two. First company is levered, it has borrowing. Second company is unlevered here without borrowing. Always unlevered first, levered second. Anyway, without tax will not make any difference. Both will have same value. But first we will do unlevered, then we will do levered. Company one levered, company two unlevered. If you have any doubts on this, let me know. It's a very important area. Approach will keep coming in exam. Net operating income means EBIT. First do company two. Without tax, no change in the answers. Now, the levered company, same 1 crore will continue. As I said, the value will remain same. Net operating income or approach is same. No change in value of firm. Same 18%. Value of debt is how much in the second company? First company, 54 lakhs. Equity balancing figure. Equity is balancing figure, which is 46 lakh. Cost of debt is 12%. Interest is 54 lakh into 12%. How much? 6 lakh 48,000. EBT is 11 lakh 52,000. Cost of equity is 1152 by 46 lakh 25.04%. Any doubts in this? This is when we do levered and unlevered without taxes. With the taxes, you will have to do amount of value of levered firm is equal to value of unlevered firm plus amount of debt into tax rate. I'm not doing that part. You can do it at home if you want to practice. Unlevered firm plus amount of debt into tax rate, and the unlevered company value also will change. It will not be 1 crore now. It will be, I think, 60 lakh because of the tax impact. Because of the tax impact, you will see value dip happening for the second company, and first company is unlevered plus amount of debt into tax rate. Now, why did says that two value will remain same? Is because of an approach called arbitrage, which is what we are going to see now. Any doubts on this? Any doubts on this? Value of unlevered. To summarize, this is what you have to remember. Cost of debt, leave it. Cost of equity, constant under net income approach, and KO is constant under net operating income approach or approach. Traditional, any other theory, they have to tell what is happening. Same logic will work if you are having identical companies, net income approach, same cost of equity, different cost of capital. Net income approach, same cost of equity, different cost of capital. NOI approach and MM approach, NOI approach and MM approach, same cost of capital, same cost of capital. Two identical companies will have same cost of capital, NOI and MM without tax. MM without tax. I'm talking about only without tax. With the tax scenario, obviously some changes will happen, which is what we do. Value of unlevered firm is equal plus amount of debt into tax rate is equal to value of levered firm. Any doubts on this? Clear? Able to understand this? Now, why is this happening? Because of an item called arbitrage, which is what we are going to see in a question now. Let's come to this question 13. In respect of two companies having same business risk, following information is given. Capital employed 4 lakh, EBIT 60,000, cost of equity 12%, levered company, unlevered company, investor is holding 20% shares in levered company. Calculate increase in the annual earning of the investor if he switches from levered company to unlevered company. What is the switching? How is it arbitrage? You'll understand when I explain this. First thing you have to decide is whether there is an arbitrage or not. For doing that, you have to value both the companies. They have given two companies. There is a levered company and unlevered company. Taxes are not there. If taxes are not there, both the companies should have same value. If value is different, it means there is a possibility of an arbitrage. And whenever an arbitrage is there, you move from one company to another company, you will have increase in earning, which is what the question is saying. What is the increase in annual earning if it switches his holding from levered company to the unlevered company? Working note 1, valuation of two firms without tax format. Valuation of two firms. Particulars, levered company, unlevered company. Levered company and unlevered company. The entire set of questions in this chapter have revolved around this format with the tax format. And earlier set of question I used to calculate interest and number of equity share and then put it in EBIT format. EBIT, right? 60,000. 60,000, 60,000. Debt 1 lakh 50 and 0. Debt 1 lakh 50 and 0. Cost of debt 10%. Equity, we will not write what is given in the question, because if I write what is given in the question, value of firm will be same, 150 plus 150. This is as per books of accounts. In valuation, it can have slight bit of variation and that can lead to arbitrage gain. This is the information as of now, okay? Cost of equity given in the question is 12%. Ideally, they'll give two different KE for both the companies. They have not given, we write same 12%. If you write two different KE, then the value may remain same also. So as of now, whatever KE they have given, I've copy pasted 12% for both the companies. Like what they can do, something like this. KE 20%, 12.5%. They can give different KE for both the companies. Here they have not done it. I've copy pasted the KE number. Now complete the table. Interest cost 1,50,000 into 10%. 15,000 0, 45,000, 60,000. Equity value 45,000 by 12%. 3 lakh. 60,000 by 12%. Value of firm. Cost of capital. It has no use, but I'm completing 60,000 by 525. This will be same 12% only. 11 point. Now, when taxes are not there, ideally both should have same value. If they are not having same value, it leads to something called as arbitrage opportunity. So here, levered company is 525, it's overvalued. Unlevered is 5 lakh, it is undervalued. What will happen practically is people will keep selling their shares in levered company. They'll keep selling their shares in the levered company. As you keep selling a company share, the value will go down. 525 will go down to maybe 520, 515. Other company value will start going up. Both will become equal. Both will become equal. So if you see here, the question says, what is the increase in earning if I switch my holding from which company? Levered to unlevered. So today I'm a shareholder of levered company, which is overvalued in the market. I don't like this company. I will sell my shares and move to the other company. When I move to the other company, like me, lot of people will do, and ultimately both company value will become equal. This is what Modiglani Miller gave us logic, saying that two companies, when taxes are not there, should have same value, because both the companies are earning only 60,000 rupees EBIT, so both should have same value. If you do not have same value, arbitrage will happen. Now, right below this, primary arbitrage exists. The situation is called primary arbitrage. Primary arbitrage exists as the value of levered firm is more than value of unlevered firm. Working note 2, compute present earnings of investor. Present earnings of investor. Particulars and amount. Value of equity of levered company. I'm a shareholder of the levered company. Value of equity of levered company 3,75,000. And it says I am holding 20% shares. I'm holding 20% shares. My investment 3,75,000 into 20%. 75,000. Overall dividend of levered company. Look at the above table and tell me what is the dividend. Dividend is EBT. Overall dividend of levered company. In that I get 20%. My income 45,000 into 20%. 9,000 is my income. Now what I do is sell my shares and move to the other company When I sell shares and move to the other company, I at least want to get 20% shares of the other company. At least 20. More than 20 is good, but at least 20. If I want to get 20% of the other company, I need 5 lakh into 20%. I need 5 lakh into 20%, which is a requirement of 1 lakh rupee. If I sell shares, I'll get only 75,000. I'll get only 75,000. So what they say is, when you're moving from a levered company to another company, if you're having shortfall of money, please borrow more money and then invest in the other company. Borrow money and invest in the other company. Working note 3, switching of holding, switching of holding and new earnings. Switching of holding and new earnings. Inflow from sale of shares 75,000. Inflow from sale of shares. Inflow from borrowing. Inflow from sale of shares. Inflow from borrowing. I don't have full money, so I'll borrow money and buy it in the other company. How much I'll borrow is whatever is the debt equity ratio of this entity. 3,75,000, 20% was my holding. Assuming I go to the market and borrow 1,50,000 into 20%, borrow 1,50,000 into 20%, exactly that money I will have, and I will pay interest at the rate of 10%, exactly in line with the corporate leverage. The logic says, or he says, you have to borrow in line with the corporate leverage. What is corporate leverage? Is the other entity 3,75,000 equity, mine was 75,000, borrowing was 150 of that company. Now my borrowing is 150 into 20%, 150 into 20%. So borrowing is equal to 1,50,000 into 20% at 10% rate of interest. At 10% rate of interest. Inflow from sale of shares, inflow from borrowing, exact. If you are holding 20%, borrow 20% of the debt. If you are holding 10%, borrow 10% of the debt. Total money available. Total money available. Investment in equity of unlevered company. 1,05,000, I'll put it in the other company. I'll put 1,05,000 in the other company. I had 75,000 by sale of share, borrowed another 30,000 rupees and invested in the other company 1,05,000. Let me complete this. I'll explain again. Percentage shareholding acquired. What is the value of equity of the other company? Sorry? So I will now become a shareholder of 21%. 20%, I'll become 21% shareholder, and which is where my income will go up. Become a shareholder of 21%. And this is the game we are trying to play. This will give us extra income. New dividend income. New dividend income. New dividend income. What is the dividend income of the other entity? I will get 21% of that. I'll get 21% of that. 60,000 into 21%. If you had acquired 20%, no extra income will come. If you get 20%, no extra income. Because you are getting 21%, there is going to be extra income. How is that happening? You'll understand. Tell me the income now. Less interest paid. We borrowed some money. We have to pay interest on that. Less interest paid. Interest paid. Final income. 9,600. And earlier our income was only 9,000. Now income has gone up to 9,600. If you had got exact 20% stake, no, it would have given you 12,000 rupees minus 3,000 interest. You would have got only 9,000. Exact 9,000 only would have got. That extra 1% is leading to extra income for us. Increase in income. Increase in income. $600. Yep. This is called primary arbitrage, where you move from a levered company to an unlevered company. What you do here is, you have your shareholding in the first entity, you sell the shares, you are having lesser money. Because of shortfall in money, what you do is you go ahead and borrow money in line with the corporate leverage, so that 20 becomes 21% stake for you, and that gives you extra income. That gives you extra income. Exact opposite is going to be the other situation, which is called reverse arbitrage. We are not going to solve it fully. You will be in lesson mode. This is the situation. Following data is available in respect of two companies, same business risk, capital employed, debt, equity, cost of equity. An investor is holding 15% shares in unlevered company. 15% shares in unlevered company. Calculate the increase in annual earning if it switches from what? Unlevered to levered. First thing you have to do, valuation. Let's not do it. Valuation. data is given. When you do valuation, first company 2 lakh value, second company 2 lakh 40 value. First company 2 lakh, second company 2 lakh 40. This is called reverse arbitrage. Unlevered is more, levered is less. Why it's called reverse? Because every problem we did till now, we have understood only that levered company will have a value higher than unlevered company in case taxes are there. Without tax, the both have to be same. But if taxes are there, levered will be higher. If rare scenario, if unlevered is higher, it's called reverse arbitrage. Unlevered is higher is called reverse arbitrage. Now, I am having 15% in this, 36,000 rupees. And my income is 15% of this, 4,500. 15%, 4,500. So 36,000 rupees is there with me now. With this 36,000, I will move to the other company. When I move to the other company, I get a surprise. Other company 1 lakh into 15% is only 15,000. I need only 15,000 rupees, but I am having what? 36,000 rupees. I am having 36,000 rupees. Other entity wants only 15,000 rupees. So there they say, because you have lot of money now, don't borrow, but invest in both debt and equity in the proportion of 1:1. What is 1:1? 1 lakh, 1 lakh. Invest in both debt and equity in the proportion of what? 1:1. That is, invest 18,000, 18,000. You will get 18% stake of the other company. You will get 18% stake of the other company. You will get interest income, dividend income. Earlier we got dividend income and we paid interest. We paid interest. Now you will get interest income as well as dividend, because we have lot of money. We have lot of money. So the concept says invest in debt as well as equity. Invest in debt as well as equity. So I invest in 18,000, 18,000, and I get interest income, and there's an increase in earning of 900. Increase in earning of 900 because I got 18% stake. I got 18% stake. To put it simply, it is like this. Compute value of two firms. Compute present earnings of the investor by assuming some investment. They have given the investment 10%, 20%. Sell shares, borrow in line with corporate leverage. Sell shares, borrow in line with corporate leverage and invest in other company. This is called primary arbitrage. In reverse arbitrage, sell share, invest in debt and equity of levered company. Invest in debt and equity of levered company and calculate the new earnings. There will be an increase in earning. There will be an increase in earning. This is called arbitrage. So he said reason for the two companies to have same value is arbitrage. If both the companies do not have same value, what you will do in this example, I will keep selling unlevered company, 2 lakh 40 will go down. Keep buying levered company, 2 lakh will go up. Ultimately, both will become 2 lakh 20 or 2 lakh 30 or 2 lakh 10. Both have to become equal. Both have to become equal. That is the concept they had indicated. Clear? Any doubts on this? With this chapter gets over and we are broadly done with around 15 marks of the subject. So we are done with the first chapter, which is your cost of capital as well as capital structure. In capital structure, it is bifurcated into 3-4 segments. First is you'll have to analyze something called as, if I look at from a chart point of view, I have to start with understanding capital, long-term money, capital structure composition. Optimum capital structure is one which can minimize the cost of capital or maximize something called as value of firm. This format we use, and then identify various alternative, compute interest, preference dividend and number of equity share, and identify with EPS, MPS, EBIT computation post expansion. New EBIT is equal to new ROC into new capital employed. ROC or ROI both are same. How do you calculate ROC or ROI? That is equal to EBIT divided by capital employed, and new capital employed is old capital employed plus the extra capital employed which is being brought in, and earlier ROI plus extra. If nothing is there, you can copy paste the same ROI. Then indifference point, level of EBIT at which two plan will have same EPS. You have to identify the plan, compute interest, preference dividend, number of equity share, assume EBIT as X, get EPS in terms of X, equate them and solve it. You will get the answer. If you are not able to solve, one plan is dominating, other plan with low BEP is dominating the plan with high BEP. Level of EBIT at which EPS is 0, interest plus PD divided by 1 minus tax rate. Capital structure theories, relevance model are there. What is relevance model is? the change in composition can change the value. Irrelevance model is NOI and MM approach without tax. They said no change in value of firm. NO, no change in value of firm. Net income approach said cost of equity will remain same for all rework scenario, are identical companies. NOI and MM says cost of capital will remain same. Other theories they have to give in the question. Without taxes, this is the format. Three formulae: interest by value of debt, EBT by value of equity, EBIT by value of firm. Not three, they are 9 different formulae. And similarly, into 1 minus t, into 1 minus t, into 1 minus t. And if you are doing MM approach with tax, first do the unlevered firm. Levered is unlevered plus amount of debt into tax rate. And finally, arbitrage, primary arbitrage and reverse arbitrage. Clear? Any doubts on this? Okay, let's take a break. After the break, we'll resume at 2 o'clock. Okay, I'll move to the next chapter, which is on leverages. We're done with two major chapters: cost of capital, capital structure. Broad overview of leverages. It is a single format chapter. There is one format. We follow that format. Automatically, all question will get solved with that. Easiest of the lot, less time consuming chapter. I'll not discuss the format, formula, everything directly in questions. Let's directly get into problems. There, everything will get discussed. And this chapter has a lot of good MCQs in the beginning, because the 2-mark MCQ, standalone MCQ, can high probability come from this chapter. There are some 10-12 good MCQs which are there to start the chapter. Do go through them once the chapter is over. Let's come to question 1. ABC Industries is a mid-size company manufacturing consumer goods. Last quarter, the company reported sales of 2 lakh. Production process involves significant variable cost which account for 50%. Additionally, it incurs 40,000 fixed cost. It also borrowed funds leading to 10,000 interest. Company is currently planning a new marketing campaign aimed at boosting sales by 10%. As a financial analyst, you are required to calculate the combined leverage. Illustrate the impact of 10% sales increase using the combined leverage. So, something on combined leverage is asked. The term leverage basically means the reward is going to be disproportionate. We have a format. Let's write the format and automatically we'll discuss there. Working note 1, computation table. Computation table. Particulars in 2 amount columns. One original situation, there's some rework to be done. Original, rework I'll explain later. Original and rework. It's a single column, single format chapter. Write the format: sales less variable cost. You have to combine the format of marginal costing with the earlier chapter. Contribution less fixed cost. EBIT less interest. EBT less tax. EAT less preference dividend. EAES number of equity shares. EPS. Some of the items are not there in this question. This is the usual format, starting from sales till earnings per share. Starting from sales till earnings per share. Now, some question I may stop at EBT. If tax is not there, we stop at EBT. If income tax is there, you can go until EAT, EAES, and number of equity share available, go until earnings per share. Otherwise, a stop may have to be done at EBT or EAES depending on data. This question will stop at EBT. Let's write the original data. What is the sales figure? 2 lakh. Variable cost is 2 lakh into 50%. 1 lakh. Contribution 1 lakh. Fixed cost is 40,000. EBIT 60. EBIT 60. Interest is 10,000. Is the tax rate given? No. So it stops at 50,000. It stops at 50,000. Then they are saying illustrate the impact of 10% sales increase using the combined leverage. So first I'll do a 10% sales increase, complete the table, and then we use the concept of combined leverage to illustrate the impact. In the other side, 2 lakh becomes 2 lakh 20. 2 lakh becomes 2 lakh 20. Negative 110. Fixed cost 40. This question stops at EBT. You cannot do beyond EBT. Now, what is leverage is sales has gone up by 10%, but my final profit figure has gone up by 20%. 50,000 has become 60,000, which is a 20% increase. This we have to validate or prove through the concept of leverage. Below the table, they've asked only combined leverage, but we are going to do something else first. Operating leverage, right? Operating leverage is equal to contribution by EBIT. Original situation only. Contribution by EBIT. 1 lakh by 60,000. 1 lakh by 60,000. Give me a 4 decimal answer. Operating leverage is related to operations of the company. This would mean that if sales increase by 10%, which is what has happened in the question, sales increase by 10%, EBIT will increase by 10 into 1.667, 16.67%. EBIT will increase by 16.67%. This is what operating leverage is all about. Operating leverage is related to operations of the company. It starts with sales, ends with EBIT. Any leverage is the starting increase and ending increase. Starting is sales increase, ending is EBIT increase. Operations start with sales, end with EBIT. In the calculator, 60,000 plus 16.67%, you will get 70,000. 60,000 plus 16.67%, you will get 70,000. 60,000 plus 16.67%, you will get 70,000. Sales went up by 10%. EBIT has gone up by 16.67% due to operating leverage. Next, financial leverage is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax. 1 minus tax is only for preference dividend. Anyway, none of them is there in this question. EBIT divided by EBT minus preference dividend divided by 1 minus tax. EBIT is 60,000. EBT is how much? You get 1.2 times. This would mean that if EBIT is the starting of the financial, okay? If EBIT increase by 16.67%, if EBIT increase by, it's ideally 1%, but I'm taking the same number, 16.67%, EPS slash EAES slash EAT slash EBT. EPS slash, the proxy for EPS is earnings available to equity shareholder, which is not there in the question. Proxy for that is earnings after tax, not there in the question. Earnings before tax. In case preference dividend is there, all the 4 cannot come. Without preference dividend, all the 4 will have same change. EPS, EAES, EAT, EBT will increase by 16.67 into 1.2. Will increase by 16.67 into 1.2. How much you get? 20%. It will be 20%, rounding of difference. Financial leverage measures EBIT with EPS. If EPS is not there in the question, EAES. If EAES is not there in the question, EAT. EAT not there in the question, EBT. So logic is very simple. This is from here to here is operation. From sales till EBIT's operation, sales change with EBIT change is called operating leverage. EBIT to EPS is financial leverage. EBIT change with EPS change. EBIT change with EPS change is called financial leverage. Linking them together is combined leverage. Combined leverage is equal to multiplication of the two. Combined leverage is equal to our numerator of the first one and denominator of the second one. Multiplication of OL into FL, EBIT will get cancelled. Multiplication of OL into FL, EBIT will get cancelled. Contribution divided by EBT minus PD divided by 1 minus tax. 1 lakh divided by 50,000 2 times. Combined leverage is the starting and the ending. Starting is sales, ending is EPS, proxy for EPS is EAES, proxy for EAES is EAT, proxy for EAT is EBT. This would mean that if sales increase by 10%, which is what has happened in the question, sales increase by 10%, EBT will increase by 10% into 2, 20%. And in this question, EBT has gone up by 20%. This is what three leverages are all about. Once you understand these three, it is kind of taken care. The chapter kind of gets over with this format and broadly this discussion. We'll do questions, but this is what broadly the chapter is all about. Any doubts on this? Clear? Can we proceed? Okay. They have given the information. It is there in the format which we want. The format is sales less variable expenses, contribution less fixed expenses, EBIT less interest, EBT. If it was not in this format, I'll put it in the format. Calculate by what percentage EBT will increase if sales increase by 6%. Which leverage links sales and EBT? Combined leverage. We'll calculate in some time. By what percentage EBIT will increase if there is a 10% increase in sales? Sales and EBIT, which leverage? Operating leverage. By what percentage EBT will increase if EBIT increase by 6%? Financial leverage. Let's first calculate the leverage, right? Operating leverage equal to contribution by EBIT. Contribution by EBIT 1,40,000 by 40,000. 3.5 times. Financial leverage EBIT by EBT. I'm not writing minus PD and all. If it's there, we write it, else just EBIT by EBT. EBIT by EBT. Fairly simple chapter. 40,000 by 35,000. 4 decimal answer, 1 point. You can multiply the two or write the formula contribution by numerator of the first one, denominator of the second one. Four times. .5, 1.1429 and 4 times. Clear? Now write EBT change with sales increase of 6%. With sales increase of 6%. Combined leverage is equal to percentage increase in EBT. This is another formula, by percentage increase in sales. It measures EBT change for the sales change. Percentage increase in EBT by percentage increase in sales. We know the combined leverage number. We write the number and then get the answer. percentage increase in EBT by percentage increase in sales. Or directly into 4 you could have done. Basically the same thing. How much is the combined leverage? 4 equal to percentage increase in EBT divided by 6. %24. EBT will go up by 24%. They can give the other way around also. They can say EBT has increased by so much. How much is the sales increase? In that case, it will become division. So 24% will be the increase in EBT. Any doubts on this? Second part is EBIT increase with 10% increase in sales. EBIT with 10% increase in sales. EBIT is with which leverage? EBIT and sales. Operating leverage. Operating leverage is equal to percentage increase in EBIT by percentage increase in sales. Increase, decrease, it can be anything. Percentage increase in EBIT by percentage increase in sales. By sales. How much was the operating leverage? 3.5 is equal to percentage increase in EBIT by 10. Percentage increase in EBIT is 35%. EBIT is increasing by 35%. Clear? Then the last one is EBT with EBIT. EBT with EBIT is related to financials. Sales with EBIT is operation. EBIT after that is financial, and sales with the last item is combined leverage. So EBT increase with 6%. EBIT increase. EBT increase with 6%. EBIT increase. Financial leverage is equal to percentage increase in EBT divided by percentage increase in EBIT. It's not EBT, it should be EPS, but the proxy for EPS is EAES, the proxy for EAES is EAT, and the proxy for EAT is EBT. How much the financial leverage? .85. 86%. 6.86%. Any doubts on this? Clear? Can you proceed? Let's come to question 3. Details of Kshitij Limited are given below for the year ended 31st March 2025. Sales, fixed cost, break-even sales, equity capital, income tax rate, cost of debt 9%, debt 90 lakh, required to calculate operating, financial, combined and PV ratio, return on capital employed and EPS, financial leverage favorable or not, percentage change in EPS, at what level of sales PAT will be equal to 3/4 of the current value. So a lot of things have been asked. We'll first try to put this in that format. When we put it in the format, some of the missing data will come and automatically we'll be able to answer whatever requirements are there in the question. Open the format. This will go on till earnings per share because EPS is asked in the question. It will go on till EPS. Open the format from sales, particulars calculation amount. Particulars calculation amount. Starting from sales till earnings per share. Sales till earnings per share. Now sales is given. Let's write that 180 lakh. Whatever is available, let's write it. Balance will get sales 180 lakh. Fixed cost excluding interest 45 lakh. Break even sales is 120 lakh. Break even sales is 120 lakh. We'll try to use this in some time. Break even sales into the PV ratio can give me something called as fixed cost. Using this, somewhere PV ratio will come and automatic. Okay, take let's use it. Come down, right? PV ratio is equal to PV ratio is equal to, this is marginal costing formula. PV ratio is equal to fixed cost by break even sales. Fixed cost by break even sales. Fixed cost by break even sales. 45 lakh. Break even sales is how much? 120. Get the PV ratio into 100. 37.5%. PV ratio is 37.5%. Come up and write here. Variable cost is 180 lakh into 62.5 balance. Variable cost 180 into 62.5. 62.5. 112.5. Contribution is EBIT 22.5. Okay. Interest is, they have given cost of debt in the question. I'm assuming whatever is given is after tax cost of debt. Interest you have to calculate at pre-tax level. What is this is after tax? I have to calculate the pre-tax cost and then calculate the interest. So pre-tax cost below the table, pre-tax cost of debt is equal to pre-tax cost of debt is equal to pre-tax is equal to post-tax divided by 1 minus tax rate. Post-tax divided by 1 minus tax rate. 9 divided by, what is the tax rate given? 25%. This will give you the pre-tax. Basically 12% is the interest rate and after tax cost of debt is 9%. Interest is 90 lakh into 12%. 90 lakh into 12%. EBT 11.7. 11.7 into 25%. 2.925. EAT 8.775. No preference dividend. 8.775 lakhs is the number of shares is how many? 150 lakh divide by 100, 1.50 lakh. 1.50 lakh, we are doing it in the lakh and then get EPS. 8.775 divided by 1.5. 5.85 per share. Earnings per share is 5.85. Clear? Once the table is done, come down solution. The table is the most important part. Now we'll be able to answer most of the requirements. Solution. First requirement is the three leverages. Operating leverage is equal to, you can refer the screen if you want, write the formula, automatically answer will come. Any doubts on the three leverages? It comes automatically from the table. You just need to apply the formula. Contribution by EBIT, EBIT by EBT, and contribution by EBT are OL into FL. You can multiply the two also or apply the formula. Both will give almost the same number. Some small rounding of difference can be there. Any doubts? Then the next requirement was PV ratio is already done. We will write the PV ratio. We have already calculated PV ratio. Just give me a minute. PV ratio is 37.5. Next requirement was return on capital employed, right? Return on capital employed is equal to, return on capital employed is equal to, in bracket pre-tax, ROC pre-tax is equal to EBIT by capital employed. Formula is in ratio analysis chapter. Nothing but ROC is nothing but cost of capital formula. What is cost of capital? ROC is capital employed. Capital is EBIT divided by value of firm. Value of firm is debt plus equity, which is called capital employed. ROC is equal to EBIT by capital employed. EBIT is 22.5 lakhs. Capital employed is debt plus equity. Debt is 90 lakh. Debt is 90 lakh. Equity is 150 lakh into 100 to express in percentage. 9 point. This is one answer. Second answer is post tax. ROC pre-tax, ROC post-tax, pre-tax and post-tax. ROC is return on capital employed. Return on capital employed is on the capital we earn EBIT. We used this when we were doing the earlier calculation also. There I called it as ROI. ROI is equal to new EBIT by new capital employed or old EBIT by old capital employed. Same thing here. The other formula is EBIT into 1 minus tax rate. If you want to do after tax divided by capital employed, 22.5 into 0.75 divided by same 90 plus 150 into 100. 7.03 0313%. 7.0313%. ROC is EBIT by capital employed. Clear? Now in the question they're asking EPS is done. Does it have favorable financial leverage? Now, right, financial leverage split into two. Favorable, unfavorable, favorable and unfavorable, favorable and unfavorable. What is financial leverage? Is borrowing money. Borrowing can be better or bad, depends on one thing. It depends on cost of debt less than ROCE, it is favorable situation. If my cost of debt is 5% and I am earning 20% on capital employed, it is a favorable situation. And if cost of debt is greater than ROCE, it's an unfavorable situation. It becomes an unfavorable situation. In this question, cost of debt is greater than return on capital employed. If you compare it pre-tax, either compare it pre-tax or compare it post-tax, interest rate is 12% and our ROC is some 9.375. And if you do the after-tax comparison, it is 9% and 7.03%. So in this question, it is negative financial leverage. Does it have favorable financial leverage? Answer is no. It does not have favorable financial leverage. It is an unfavorable financial leverage. And all of this, we have assumed this 9 to be after tax. Solution can assume 9 to be pre-tax, then the answer will automatically change. So 9 we have taken as after tax and did the question solving. Which leverage links EPS and EBIT? Which leverage? EPS and EBIT. Financial leverage. Now, right. Financial leverage is equal to percentage change in EPS by percentage change in EBIT. Percentage change in EPS by percentage change in EBIT. EPS by EBIT. What is the financial leverage number? 1 point is equal to percentage change in EPS by 15. 15. 28 point. You can say 28.85 increase, 28.85 decrease. If there's an increase in EBIT, EPS will increase by 28.85%, and if there's a decrease, it will decrease by 28.85%. At what level of sales PAT will be equal to 3/4 of the current value? One way of doing it is doing the statement again. In the statement PAT 8.775, you make it as 3/4 of this number. 3/4 of the current value. PAT will become 3/4 of the current value. That is one way of doing. Second way of doing is using the leverages understanding. Next, right. At what level of sales PAT will become 3/4 of the current value. Three-fourth of the current value. Percentage fall in PAT. Percentage fall in PAT. 3/4 of the current value means it goes down by 1/4. It goes down by 1/4, 25% fall. 25% fall. Percentage fall in sales. Question mark. Sales has to fall. PAT will fall if sales is falling. PAT will fall if sales is going down. Percentage fall in sales is question mark. Which leverage links sales and PAT? Combined leverage. PAT is the proxy for EPS, EAES, PAT, PBT. It goes in that order. Combined leverage is equal to percentage fall, percentage fall in PAT by percentage fall in sales. Percentage fall in PAT by percentage fall in sales. How much was the combined leverage? 3.76. 92 times is equal to 25 by percentage fall in sales. This will give you the percentage fall in sales, and the new sales is old number minus the fall. Percentage fall in sales is equal to 25 by 5.7692. 4.3333. New sales is equal to 180 lakh minus 4.3333 percentage. Some 172.20 lakhs. If sales is 172.20, you will get the number which is equal to 3/4 of the current PAT. All of this with one assumption: the given cost of debt is after tax. If it becomes they take pre-tax, then everything will undergo a change. Other approaches, you write the say EAT number, reverse work get the EBT number, reverse work get the EBIT number, reverse work get the contribution number. Contribution divided by PV ratio will give you the sales. Yeah, we have taken it to be that way only, the interest part, and you get the number as 4.33, 172.20 lakh. Any doubts on this? Any doubts on this? We have used all the linkages of the leverages again in this question. Go through question 4. Okay, they have given some initial information. We'll put it in our format, and it says calculate the decrease in EPS, degree of OL and FL separately if sales are declined by 15% and 20%. The OL and FL number keeps changing as you do another income statement. So we'll do an existing statement: 15% fall, 20% fall. In the table itself, we will do till EPS, and after EPS we'll do OL, FL and percentage decrease. They want us to know what is the percentage decrease which is happening. Put the format: income statement, EPS, particulars, original, 15% fall and 20% fall. 15% fall and 20% fall. Original 15% fall and 20% fall. We have not seen question with preference dividend till now. Those questions will come as we proceed. You can keep doing it, refer the screen if you want, but more or less self-explanatory, nothing much tricky. In the table itself, complete OL, FL, everything. Complete it and let me know if you get any different numbers. And you have to calculate percentage fall in earnings per share. From the original, how much is the fall? Complete it. Let me know if there are doubts. Yeah, numbers are, I think, whatever I've calculated matches. Percentage fall in EPS is to be calculated. I can use that calculate using combined leverage, but okay, we are not doing CL. So directly we compare the two numbers and find the percentage fall in EPS. Four 24 minus 604 divided by 604, 364 minus 604 divided by 604. It's a calculation oriented question. No major application of concepts. Any doubts in this? Clear? Can you proceed? Any doubts in this? You had to do it at three different stages: original numbers, and then at a 15% fall, then at a 20% fall, and the OLFL numbers will undergo change. Any doubts on this? Clear? Go through question 5. Okay, they have given an income statement. It is almost in the format which I want, but still I do not have a contribution item there. So I'll put it in our format, that is starting from sales going on till earnings per share. Once that format is done, we will calculate OL, FL, and CL. If total assets remain at same level, sales increase by 20, decrease by 20, what will be the EPS at the new sales level? Which leverage links sales and earnings per share? Combined leverage. So using the combined leverage, we will answer this. Let's first do the income statement. Same format, starting from sales till EPS. Sales till EPS. Sales less variable cost till earnings per share. Write the format. Okay, let's copy the numbers. Return the first, write the format quickly. Sales is 3 lakh 40. Operating expense 1 lakh 20, including depreciation. Depreciation in the below they have said if all operating expense other than depreciation are variable cost, so depreciation is a fixed cost. So this is 60,000 is variable contribution and balance 60,000 is fixed. Depreciation is fixed. Balance copy paste only. Number of equity shares are 80,000. EPS 1.3. Earnings per share is 1.3. Now we'll have to answer all those three leverages and then say the link between the sales and the EPS. Link between the sales and the EPS. Operating leverage is equal to contribution by EBIT. 2 lakh 80 by 2 lakh 20. 280 by 220. 4 decimal. 1.2727 times. EBIT by EBT. $1.375. We can multiply or take the numerator divided by the denominator of the second leverage. $1.75 times. Straightforward, simple calculation. We will see question where preference dividend will also come. These initial set of question, I do not have the preference dividend there. 1.75 times. Any doubts on this? Clear? Can we proceed? Sales and EPS change. Sales and EPS change. Sales and EPS change. Combined leverage, right? Combined leverage is equal to 1.75 times. Combined leverage 1.75 times. Sales change. Sales change. They have given two things. One is up and down. Both we will analyze it. Sales changes 20%. EPS changes 20 into 1.75. If they give the other way around, EPS sales is divided by 1.75, 35%. The question wanted new EPS. If total asset sales change, what will be the EPS at the new sales level? They want the EPS number. They don't want us to just calculate the change. New EPS with sales increase of 20%. 1.3 plus 35%. If sales is increasing, EPS will increase by 35%. 1.3 plus 35%. How much? And 7, new EPS with sales decrease of 20%, minus 35%. 845. 1.755 and 0.845. Clear? Any doubts on this? Go through question 6. Okay, they've asked us to calculate operating and financial leverage and combination which will give highest value and lowest value. Now, in this question, fixed cost they are saying can be 3,000, can be 6,000, can be 9,000. Similarly, my interest cost depends on whether it is a plan A or plan B. In plan A, my interest cost is 15,000 into 12%, and in plan B, my interest cost is 7,500 into 12%. So, what we are going to do is we are going to do our format till EBT, not beyond EBT because tax is not there, but particulars in 6 columns. What are 6 columns? Fixed cost 3,000 plus plan A, 3,000 plus plan B. 6,000 plus plan A, 6,000 plus plan B, 9,000 plus plan A, 9,000 plus plan B. In that, I will do 3,000 plus plan A and 9,000 plus 3,000 plus plan B we will do in the class, and 9,000 plus plan A we will do in the class. Others we are not going to do, but particulars in 6 column. Open particulars in 6 columns. Particulars and 6 columns. 3,000 plus A, 3,000 plus B, 6,000 plus A, 6,000 plus B, 9,000 plus A, 9,000 plus B. This two alone we will do 3,000 plus B and 9,000 plus A. Anything I can do, but I'll just do these two 3,000 plus B and 9,000 plus A. Others we are not going to fill. And in the table itself, after EBT, OL, FL, CL, because they want the combined value which will be the highest and which will be the lowest. OL, FL, and CL. Let's do the second column and the fifth column. 3,000 plus B and 9,000 plus A, and automatically it will give us the required answers. What's the sales number? 72, 2,400 into 30. 72,000. Variable cost is 2,400 into 20. Contribution 24,000. Fixed cost 3,000, 9,000, 3,000 and 9,000. If you had done other situation, we'll write 3,366 and go on like that. 21, 15. Interest cost is 7,500 into 12%. 7,500 into 12%. 15,000 into 12%. And you'll end up answering OL, FL and CL. OL is contribution by EBIT, FL is EBIT by EBT. You can multiply the two or do contribution by EBT. Like this, 6 different answers will be there. The one with the lowest value and the highest value you have to identify, which will be these two situations. But anyway, we have to do all the 6 and then find the lowest one and the highest one. The lowest combined leverage will be, I think, 1.1940. Highest will be 1.8182. They said which combination will give the highest value and the least value. This was 6 situation. If they give 3 fixed cost and 3 different financial plan, it will become 3 into 3, 9 situation. Here it was only 6 situations. Any doubts on this? Clear? Highest value in situation 3 and plan A, which is the 5th column of us, and the lowest values in situation 1 and plan B. These two situation alone I had said we will do, others we are not doing it. Any doubts on this? Go through 7. Okay, they have given us a balance sheet or a summarized capital structure, equity capital, preference, and debenture. So this question has preference capital. PAT is given, some data is given. They've asked us to calculate OL and FL, which we will do. Preference and equity share of dividend, coverage ratio, earnings yield, price earning ratio, all this ratio analysis question. You can do it later at home if you want, or see it once we are done with ratio analysis. and net fund flow. These two elements alone, we will do net fund flow and operating and financial leverage part. Now we'll first put it in our usual format, starting from sales till earnings per share, And once the table is done, automatically OL and FL will come from there. Let's put the format first, starting from sales till EPS. Particulars calculation amount. Calculation amount. Sales till earnings per share. This question, preference dividend is also there, so that adjustment will also get discussed here. Okay, let's fill whatever is available. Profit after tax 1,82,000. 1,82,000 profit after tax. Tax rate is 30%. Tax rate is 30%. So PAT 182, PBT is PAT divided by 1 minus tax rate. Divided by 1 minus tax rate. 1,82,000 divided by 1 minus 0.3. 2,60,000. 260. Interest is available in the question from the capital structure. From the capital structure, interest is 10% debenture 4 lakh rupees. 10% debenture 4 lakh rupees. 4 lakh into 10%. Negative 40. EBIT. EBIT is 3 lakh. EBIT is 3 lakh. Once the income statement is done, it's almost over. EBIT is 3 lakh. One reason to discuss this is because of the preference dividend part. EBIT is 3 lakh. Operating expenses 1.5 times of EBIT. In that, depreciation is there. Depreciation I take it as fixed. Others I take it as variable. So depreciation 90,000. Contribution 3 lakh 90. Depreciation 90,000, which is fixed cost. Contribution 3 lakh 90. 3 lakh into 1.5 minus 90,000. Sales is 7 lakh 50. Reverse working 3 lakh into 1.5 minus 90,000. 3 lakh into 1.5 minus 90,000. Preference dividend number is 6 lakh 25,000 into 8%. 50,000. EAES 1 lakh 32. EAES 1 lakh 32. Number of equity shares is how much? 80,000. EPS table is over. We will answer OL and FL here, and one item called net fund flow, which is not a very big thing, but I have to discuss that. Any doubts here? Operating leverage is equal to contribution by EBIT. Contribution by EBIT 3 lakh 90 divided by 3 lakh 1.30 times. FL equal to EBIT by EBT minus PD divided by 1 minus tax rate. EBIT by EBT divide EBIT divide by EBT minus PD divided by 1 minus tax rate. P lakh, 2 lakh 60. Preference dividend you have to divide by 1 minus tax rate. PD part we have to divide by 1 minus tax rate. PD is 50,000. What's the tax rate? 30%. P lakh divided by 50,000. 188,571 is the denominator. 188,571 is the denominator. P lakh by 188,571 was the answer. 5, 9. Any doubts on this? 1.59 times. Clear? Preference dividend divided by 1 minus tax rate. Next, net fund flow is equal to PAT. What is net fund flow? Is how much is the business generating? Add depreciation non-cash item minus equity dividend minus preference dividend. If you don't deduct the equity and preference, that's called gross fund flow. That is the funds business is generating, but from there I'm paying equity dividend and preference dividend. Net fund flow is equal to PAT 1,82,000. Depreciation is a non-cash item 182. Depreciation non-cash item 90,000. Read the question and tell me how much is the equity dividend paid. 15% of 8 lakh. 15% of 8 lakh and preference dividend is 50,000. 15% of 8 lakh, preference dividend is 50,000. How much is the net fund flow? 1 lakh 2,000. Clear? Any doubts on this? Go through 8. Put it in the leverages format and complete leverages part. Balance I'll take you through. Complete leverages. Part 4 of the question. Balance things I'll take you through. Any doubts on the leverages part? Okay, we proceed ahead. Then the next requirement is, what is the firm's ROI? ROI is nothing but ROCE. Both are same. ROI, ROC. What is the formula? EBIT by capital employed. Right. ROI is equal to EBIT. No after tax calculation here. Only one answer because tax rate is not there. EBIT by capital employed. 27 lakh. Capital employed is 45 plus 55. 27%. ROI is 27%. 45 plus 55. ROI 27%. Next, does it have favorable financial leverage? I will have to compare ROI with what? Cost of debt. Favorable, unfavorable here? Favorable, no? This is favorable. ROI is more than cost of debt. ROI is more than cost of debt. ROI is 27%. Cost of debt is only 9%. It's a favorable situation. We are earning more than what we are paying. Then third part, capital turnover 3 times. We are not doing it. Capital turnover ratio formula. Capital turnover ratio, sales by capital employed. Using that ratio, you'll have to finally say whether you have high capital turnover or low capital turnover. If the sales drop to 50 lakh, what will be the new EBIT? Sales and EBIT is linked through operating leverage. You can either use operating leverage understanding or directly here itself in the side sales. Another amount column, sales is 50 lakh. Sales is 50 lakh. Variable cost will also proportionately go down. Variable cost will proportionately go down. Sales has gone down by 1/3. Variable cost will also go down by 1/3. Proportionately go down 28 lakh. Contribution 22 lakh. Fixed cost is 6 lakh. EBIT 16 lakh. The same answer in the printed material I would have done using the operating leverage. 16 lakh. So if sales go down to 50 lakh, if you look at the printed answer, 33.33, 40.74%, and you get 16 lakh as the answer. Which leverage links sales and EBIT? Sales is increased by 10%, EBIT will increase by 10 into 1.2222. 10 into 1.222 times, we are not doing it. At what level of sales will the EBT of the firm will be equal to 0? One way is to do it through the income statement. Other way is to do it through combined leverage. How combined leverage? EBT becoming 0 means EBT is going down by 100%. EBT becoming 0 means EBT is going down by 100%. How much should the sales go down? And accordingly we calculate or write another amount column. If you have space, write another amount column. EBT 0. 4,05,000. EBIT 4,05,000. Reverse order, EBIT 4,05,000. Fixed cost is 6 lakh. Contribution 10,05,000. Contribution is 10,05,000. If 33 is equal to 1005, what is 75? Reverse order. We just need to calculate, or you can calculate PV ratio and then do the answer. PV ratio and then do the answer, or you directly do, whichever way you do. 33 is 1005. What is 75? 33 is equal to 1005. What is 75? Any doubts on this? Clear? Or using the concept of leverages. Which leverage? Combined leverage, because sales has to go down by 100 divided by 1.4379. Some rounding of differences can come. Why 100%? EBT becoming 0. EBT becoming 0 means 100% fall in EBT. If EBIT increased by 20%, which leverage links EBIT and EBT? Financial leverage. So 20 into whatever is the FL number. Any doubts on this? Okay. With this, the straight working questions are done. I need to do reverse working question. I'm taking a break of 15 minutes. After the break, we'll do the reverse working question. Okay, let's do the reverse working question. I think four more questions and we should be done with today's session. Let's quickly try to cover these. Let's come to 9. From the following financial data of company A and B, prepare their financial statement. They have given certain information. Our job is to prepare an income statement. Before we start with the income statement, we'll look at whether tax rate is given in the question. Is there a tax rate in the question? Yes. Okay. Number of equity shares data there. Number of equity shares. No. So from sales till EAT, open from sales till earnings after tax. Sales till EAT, open the income statement. Income statement of company A and B. From sales till EAT. Sales less variable cost right till EAT. And then in reverse working, we'll try to get these numbers. How it happens, we'll understand as we proceed. Let's capture whatever data is directly available. Variable cost 88,000. 50% of sales, we don't know the sales number, so let's leave it. 88,000 for company A variable cost. Company B will see later. Fixed cost is 26,500. Interest cost is 14,000, 11,000. And then they have given income tax rate. Okay, EBIT is given for company B 14,000. EBIT 14,000. Company B bottom part, let's close it. 3,000. 3,000 was a tax rate. 30% 900. 2,100. Now somewhere other part we have to close it. This part is over. The bottom part is over. The top part needs to be done. I'll close first company B. Margin of safety is given in the question. Now 1 divided by margin of safety is called operating leverage. 1 divided by margin of safety is called operating leverage. And using that we'll be able to complete the company B statement. So now below the table, operating leverage equal to 1 by margin of safety, 1 by 0.25. 4 times 1 by 0.25 4 times, and then you can say operating leverage is equal to contribution by EBIT. We know the EBIT number of the company B. Contribution by EBIT. Contribution by EBIT. OL is 1 by margin of safety. That's a simple formula for operating leverage. 1 by margin of safety. Contribution by EBIT. How much is the, sorry, operating leverage is 4 times. Contribution we are calculating. EBIT is how much? 14,000. 14,000. Get the contribution number. 50. 56,000. 56,000. Contribution 56,000. Balancing figure fixed cost is 42,000. And company B variable cost is 50% of sales, which means contribution is also 50% of sales. Variable cost is 50% of sales. Contribution is also 50% of sales. 56,000 divided by 50%. 1,12,000. Company B part is over. Clear? Coming to company A, I have financial leverage. What is the formula for financial leverage? EBIT by EBT. I don't have EBIT. I also don't have EBT. But if you have the item in between them, then also you can use FL. For OL, I need contribution or EBIT or the item in between. For FL, I need EBIT or the EBT or the item in between. We have the item in between. Now write FL is equal to EBIT divided by EBT, phi equal to EBIT is X, EBT is X minus 14,000, X minus 14,000, X divided by X minus 14,000. What do you get as X? Solve, you will get the answer. 17. That's all. Income statement is over. 17,500. Complete the income statement. The straightforward, very simple kind of a reverse working question. 17,500. Reverse working contribution is 40, 44,000. Sales is 132. Down order 3,500, 1,050, 2,450. Straightforward, simple question. Nothing much tricky in this question. As we proceed, some of the difficult reverse working questions are there. Any doubts in this? Clear? Can we proceed? Okay, almost the same like the previous question, just that they have given it in words rather than giving it in a table form. Almost similar requirement. Let's see this. Company P and Q are having the same earning before tax. EBT is same. Margin of safety is 0.2, and for company Q 1.25 times that of company P. Interest expense 1,50,000. Company Q is 1/3 less than that of company P. Financial leverage is 4. Q is 75% of company P. PV ratio is there. Tax rate is there. So I have PV ratio and tax rate. So with the taxes question, we will do till EAT. We do not have other information like number of equity shares and all. Let's open the income statement. Company P and company Q. Sales till EAT. From sales till EAT, will fill whatever information is available, and that balance will try to get it through those equations. Same earnings before tax. Okay, in the table itself, write after EAT, write margin of safety. Write margin of safety. How much is the margin of safety of company P? 0.2, and company Q is 1.25 times that of company P. 1.25 times that of company P. 1.25 into 0.2. Operating leverage. 1 by margin of safety. Operating leverage 1 by margin of safety. 5 times and 4 times. 5 times and 4 times. 5 and 4. Any doubts in this? Clear? Then I have interest expense for company P is 1,50,000. Read and tell me what is for Q. 1/3 less. So from 1,50,000 remove 33.33333 percentage, 1 lakh, 150 and 1 lakh. Then below OL write FL. FL equal to FL equal to 4 times, sorry, yeah, 4 times, and now like the previous question, OL cannot be used directly. I don't have contribution, I don't have EBIT, and I also don't have the item in between. But FL can be used because I have the item in between. So let's calculate using FL. FL is equal to EBIT by EBT 4 equal to X divided by X minus 1,50,000. X divided by X minus 1,50,000. X divided by X minus 1,50,000. How much? 2 lakh. Then do it for company Q. X divided by X minus 1 lakh. The statement is almost over now. 1,50,000 and 50,000. 150 and 50,000. Any doubts on this? What's the tax rate? Apply 45%, 22,500, 22,500, 27,500, 27,500. Contribution is equal to EBIT into operating leverage. Reverse working. EBIT multiplied with operating leverage. Contribution is EBIT multiplied with operating leverage. Or you use the formula OL is equal to contribution by EBIT. EBIT goes to the other side and it becomes EBIT into operating leverage. 2 lakh into 5 times. And 1,50,000 into 4 times. Minus 8 minus 450. Contribution divided by PV ratio is sales. That's marginal costing formula. Contribution divided by PV ratio. Contribution divided by PV ratio is the sales number. What is the PV ratio? 25%. 33.33%. Straightforward, simple question. Again, using that formula of the 1 by margin of safety. That formula is what is used for operating leverage. Any doubts on this? Clear? Can you proceed? Any doubts on this? Okay, this question is slightly more complicated than the other one. Following information is available for Punya Kalash Limited: margin of safety, financial leverage, debt, tax rate, earnings yield. Unless you know this formula, you will not be able to do the question. Earnings yield formula, interest rate post tax, very clearly mentioned post tax, MPS, PV ratio, prepare income statement and find out the number of equity share. So this income statement will go on till earnings per share, will go on till earnings per share, and somewhere I have to find out the number of equity shares as per the question. That information is what they have asked in the problem. Income statement will start from sales, go on till earnings per share, go on till earnings per share. One critical part is going to be using this formula of earnings yield, which if you remember in ratio analysis what you do, it is easy, otherwise can become little bit of challenge. Let's do the format first. Sales from sales till EPS. Sales till earnings per share will fill whatever is available, balance will get it. Margin of safety is given below the table. Operating leverage is equal to, we'll see how to use it later. Operating leverage is 1 by margin of safety, 1 by margin of safety, 1 by zero point 0.4, 2.5 times. Financial leverage, we'll see how to use it. Debt 1 lakh 50, tax rate is there. Earnings yield, I'll use it in some time. Interest rate post tax, is 9%. Interest has to be calculated pre tax. So in the statement, interest, right? Interest is 1,50,000 into 1,50,000 into what's the rate they've given? 9 divided by 1 minus tax rate. 9 divided by 1 minus tax rate. How much the tax rate? Tax rate is 2. Okay, 20, 1 minus 0.25. So 1,50,000 into 12%. How much is the interest? Please use the financial leverage formula, EBIT by EBT. Use the financial leverage formula, EBIT by EBT. Financial leverage formula, EBIT divided by EBT. FL is equal to EBIT by EBT. 1.5 is equal to X divided by X minus 18,000. How much? 54,000. EBT is 36,000. Tax is 25%. 9,000. EAT. Number of equity share, EPS, what to do, we'll see. 27,000. Contribution is EBIT into operating leverage. EBIT into operating leverage. EBIT into operating leverage. 54,000 into 2.5. 1 lakh 35,000. Sales is 1 lakh 35 divided by PV ratio. Divide by PV ratio. Contribution divided by PV ratio is sales. Variable cost balancing figure 315. Fixed cost balancing figure is 81,000. Now write EPS, earnings yield is equal to If this formula you remember, it is easy, else it becomes difficult. Earnings yield is equal to EPS, MPS, EPS divided by MPS, EPS divided by MPS. EPS is, sorry, earnings yield is 12% equal to EPS by 125. This will give you the earnings per share. Number of equity shares is balancing figure. 27,000 divided by 15,800 shares. Clear? Any doubts on this? Done? Okay. I think next question, among the toughest possible question on reverse working, which got added in May 25 MTP. Go through this question. Lot of good adjustments are there. Okay. From the following information for financial year 23-24, FL is given, PV ratio is given, tax rate, depreciation, preference dividend is there. Other question, reverse working, preference dividend was not there. This becomes little tricky, and it is 15% of operating profit. What is operating profit? Is EBIT, and preference dividend is 15% of operating profit. Cash break even sale. With cash break even sale, you can get cash fixed cost, add depreciation, total fixed cost. Cash fixed cost, add depreciation, total fixed cost. Equity, capital, reserves and surplus. Write the income statement given. Exactly the same income statement we have to do till EAES. From sales till EAES. Lot of good adjustments in the question. The only information I have is interest 57,400. Others, lot of things we have to calculate. 57,400 is the interest amount. Now write FL is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Till now, this preference dividend part was not there in the reverse working question. PD divided by 1 minus tax rate. Not a very tough question, but yeah, lot of good adjustments are there. PD divided by 1 minus tax rate. How much is the FL given in the question? 4 is equal to X. EBT is X minus 57,400. Something they mentioned about preference dividend in the question. 15% of operating profit. 15% of operating profit. Operating profit is EBIT. So 0.15x divided by zero point 0.7 divided by zero point 0.7 divided by zero point 0.7. I take it to the other side. 4x minus 57,400 into 4, 229,600 minus zero point 0.6 by 0.7, 8571x is equal to x. Get the answer to x. After this is done, we will reverse check after writing the numbers whether it is coming right or wrong. Because reverse working with this being an extra adjustment, there's a possibility of making error. So once you are done fully, we will repeat the calculation again by writing the correct numbers. How much do you get as EBIT? Solve and let me know. 1,07,000. We will write this number and again check whether we are getting 4 times or not, because this question has a lot of extra adjustments. So we will write 107,145 in the table, complete the bottom part. After we are completing the bottom part, we will check whether this 4 times is working or wrong. In case you have done any drafting, that equation drafting error or mistake in calculation, you will get stuck there. Any doubts on 107,145? Now write here 107,145 minus 57,400 49,745. Tax rate is how much? 30%. 14,924. Three four eight two one less, sorry, preference dividend, not equity dividend, preference dividend. 107,145 into 15%. 15% of operating profit. Preference dividend is 15% of operating profit. 1607 to 18. Now I want you to repeat the formula and then check whether you are getting 4 times or not. EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Just check whether you are getting 4 times or not. Because this question, the equation was also a little complex. So it's better to recheck our calculation. 107,145 divided by 49,745 minus 16,072 divided by 0.7. Some slight difference, rounding off. If you get a bigger difference, some calculation error has happened. Yeah, I'm getting 4 times, so which means we have done it correctly. Any doubts in this? Any doubts in this part? It is very critical because this calculation was little bit complex than our other computation. Others were very fairly simple. We did not have preference dividend. Any doubts in this? Clear? Then the question has said cash break even sales. Now write cash break even sales is equal to cash fixed cost by PV ratio. Cash break even sales is cash fixed cost by PV ratio. 2,25,000 is equal to cash fixed cost. PV ratio is 40%. PV ratio is 40%. This will give you cash fixed cost. In that, depreciation is to be added because fixed cost will include depreciation also. Cash fixed cost. How much is the cash fixed cost? 90,000. So come back here. Fixed cost is 90,000 plus 10,000 depreciation. Contribution 207 145. 207 145. Sales is contribution divided by PV ratio. Contribution divided by PV ratio. Contribution divided by PV ratio. What is the PV ratio? So divide by 40%. 863, and this balancing figure is 717. Any doubts on this? I think 718. Okay. 310 718. With this, the income statement got over. We'll quickly answer the other requirement. Question major discussion is over. One was the cash break-even sale, which gives you cash fixed cost, and second was with the preference dividend. With the preference dividend, how are we going to complete the calculation? Any doubts on this? Then the other requirements were calculate operating leverage. Please complete operating leverage and combined leverage. Do operating leverage is equal to contribution by EBIT. Operating leverage, contribution by EBIT. Contribution divided by EBIT. Two lakh 7,000 by 1,07,000 by 107 145. How much? 933. Okay, 1.933. 9333. Combined leverage, either use formula or OL into FL. OL into FL into 4 times. Financial leverage is 4 times. Financial leverage is operating leverage. Sorry, combined leverage is operating leverage into financial leverage. Or you can use the formula numerator divided by the denominator. I'll directly do the multiplication itself. OL into FL. 1.9333 into 4. 7 point. Then percentage change in EPS if sales increase and decrease by 7%. Sales increase and decrease by 7%. Which leverage links it? Combined leverage. 7 into this number. 7 into 7.7332. 7 into 7.7332. So that will be the increase and decrease. When sales goes up, it will increase. When sales go down, it will decrease by approximately 54%. Clear? This was also a good adjustment. Return on equity shareholder funds as on 31/3/24. ROE is equal to EAES by amount of equity. EAES by amount of equity. The now question becomes a little bit more challenging because numbers are not proper. It is coming in decimal and other things. So because of that, it is more time consuming also. EAES by amount of equity. EAES is 18,749. And listen, amount of equity is this plus 18,749. What is plus 18,749? That will also get added to the EAES number, assuming it is not paid as dividend. If company pays a dividend, then it will not get added because they have said return on equity as on 31/3/24. So I'm using the closing number. I can argue to use the average number also, but we are using the closing number, assuming that dividends are not paid. So denominator is 1 lakh plus 35 637 plus 18 749. How much? 12 point. Give me the answer to the last one. What is the amount of debt if post-tax interest cost is 6.65? What will be the amount of borrowing if post-tax interest cost is 6.65? Post-tax is 6.65. $57 400 divided by 6.65. You cannot directly divide. This 6.65 is post-tax. You have to convert this to pre-tax and then do the division. What is the EBIT number we got? Yeah, small differences there. I think it says 106,296. Not sure. A huge difference. Yeah, that's because of rounding off. Here we have done 0.21. That's more of rounding off. Okay, let's not worry about it. Amount of debt is this. There's a small rounding of difference. We have worked with 4 decimal. They have worked with 2 decimal in the solution. Any doubts on this? Clear? So with this, I'm done with 3 main chapters. Tomorrow I'll be starting with dividend decision. We'll be doing ratio analysis. Other 2 chapters, I'm not sure how much I'll be able to touch on. Depends on whatever time is available. I wanted to focus on the important ones. So block 1, I wanted to complete major chunk today. So in block 1, we are done with 3 chapters. Capital structure, cost of capital, leverages, very important from an exam point of view. Put together around 23 marks. Dividends, though it's a 4 mark only, but the reason for putting it in block 1 is it needs lesser effort and we get more result. Why I don't want to put, despite being 11 marks, I'm not putting it in the earlier blocks is because of the time consumption element. You spend a lot of time in. Today, if I had started with investment decision, the entire day could have gone for investment decision, or at least 5 to 6 hours will go there itself. That is why I did not even touch on investment decision initially. And I'm not sure whether in the 2 days revision we'll touch on investment decision. Tomorrow we will start with dividends. Ratio analysis 100% will fully get over. Dividends will fully get over. Working capital, some part we may be able to do, some part you may be doing it. The only requirement I have is for ratio analysis, we want you to go through all the formula of ratios and come. That is the only requirement. I don't have any other requirement, no other preparation I want. Dividends, all those chapter, no preparation is needed. Only for this chapter, please go through all the formula and come. Otherwise, you will find it little difficult to follow the ratio analysis part, because others and all, even concept known, not known, you can still follow it. But ratio analysis, suddenly I'll say this formula, suddenly I'll say that formula. I'll share this charts also in the group. So you go through the charts and be clear at least on ratio analysis. Spend some time on ratio analysis. With the concept book, you go through the concept MCQs if you have time. You don't have time, I don't expect you to do anything in the 3 chapters which we have done today. You want to do something, practice, you do, but entire all the questions are discussed. Extra add on those MCQs you can complete, and concept MCQs from the concept book. And if still you have time and energy, then complete the theory part. Complete the theory part, so that in 2 days session, I'll complete 3 chapters. You completed theory. Tomorrow 2 or 2.5 chapters will get over. You'll be left with 1.5 chapters. Where also what needs to be done, I'll tell you in the session, tomorrow session. By end of the day, I'll tell you what you need to do for working capital management and investment decision, so that at least of the 60 marks, I'll call it a 60 mark paper, 40 marks fully I'll discuss it in the class. Balance 20 marks somewhere you will have to manage. Clear? We'll end with this today.